from an index standpoint, you may not see as much excitement this year.
Markets have been resilient so far and maybe more than resilient in the second half.
When you look under the hood, there's rotation happening and there's dispersion, and that's what's dampening volatility.
Ultimately, it'll be a good environment for stocks, but it's going to be a little bit more difficult.
Right now, it is about being broadly diversified.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Monday following the biggest one-day loss on the S&P 500 so far this year. Equity futures bouncing back. Your scores look like this. Up 0.5% on the S&P, on the Nasdaq 100 up by 0.3. That positive growth shock of early November felt like a long time ago in Friday's session. Consumer confidence down. Inflation expectations up. Existing home sales lower, and the worst PMI going back 17 months.
Especially when it has to do with services, not necessarily manufacturing. Suddenly, the engine of this economy seems to sputter, and growth concerns seem to be in the front and center at a time where, if you take a look at the U.S. City Economic Surprise Index, it has reached the lowest level, negative, for the first time going back to September.
This is going to be a bearish start to the program, so forgive us for the next 2 minutes or so. 6 consecutive weeks of lower 10-year bond yields. Is that good or is that bad? That move has been reinforced by weaker than expected outlooks from the likes of Walmart. The week before, weaker than expected retail sales. It's not the mix you want to see to start a new year.
It's definitely not the mix you want to see, especially for an administration that one of the reasons why they won is because they were concerned and were listening to American voters when it comes to inflation. And the Michigan survey on Friday showing these inflation expectations going up is not good news, especially when you have a threat of tariffs coming down the pipeline of this year.
Stevie Cohen, I'm actually pretty negative for the first time in a while. Tariffs cannot be positive. It's a tax. Put his name together with Ken Griffin. They're two very big names in this world.
And listen to some of the more bearish prognostication from even Warren Buffett, the man who's talking about American dominance and the incredible gift of being born in the United States. A very different tone over the weekend. At a certain point, they might be saying the quiet part out loud at a time where a lot of people are trying to justify surgical use of tariffs when they're being used in a whole host of different manners and threatened in a blanket type of way. I will just say, some people might say on a surgical level, tariffs are good and they can be used well. Right now, there is not a sense of what the ultimate goal is, and that level of uncertainty is making it very difficult for anyone to plan.
There's a couple of things to watch this week. There's two. One is earnings and the other's a data point. On the earnings front, Nvidia in the middle of this week. Later on in the week, the Fed's preferred inflation gauge, core PCE. Do you think we get a clear pass on PCE because we've had PPI, CPI, that ultimately it's not going to be a big surprise?
That's what a lot of people seem to think. We get personal income and spending alongside core PCE. Any incremental change to the upside, you can imagine people will respond much more significantly to. But right now, it doesn't seem like people are worried about longer term inflation. Right now, people are worried about the growth shock that could come, the growth hit that we can see with some of the data that's coming in less positive from a growth perspective. And so at this point, I'm not sure how even the bond market responds other than higher short end and lower long end.
The Fed seems to be on pause at the moment, and that's critical. For the Chicago Fed President Austin Goolsbee, he was asked about the University of Michigan survey and the fact that consumers do seem to be a bit concerned about inflation. He said this: it wasn't a great number, but it's only 1 month of data. You need at least 2 or 3 months for that to count. I think that's pretty much going to be the Fed throughout the entire first half of the year. Punt. It's only 1 month. We need more.
Apple, with some news already this morning in the first few minutes of this program, planning to invest over $500 billion in the United States over the next 4 years. Let's put some jobs on that. They will add 20,000 U.S. jobs to begin producing Apple Intelligence servers in Texas, a nod to the new administration.
And maybe trying to insulate themselves from coming under fire for their large presence in China, where they are increasingly partnering with local companies to try to roll out their artificial intelligence. A real question here about how substantive this is versus the signaling to a president that clearly is looking for transactional wins.
I'm not really surprised about this statement, maybe how quickly it came, because on Friday, President Donald Trump told us all of this. He said he met with Tim Cook and he's going to be investing all this money into the United States. Well, guess what? Here it is. What Tim Cook said in his statement, though, is we're bullish on the future of American innovation, and we're proud to build on our long-standing U.S. investment with this. This is what you're going to see from a number of CEOs who are trying to make sure they are blunting the threat of tariffs as well. Does this potentially mean, you have to ask, does Apple get a carve-out maybe somewhere else?
That stock in a pre-market right now down by a little more than 1%. We'll pick up on that story throughout this hour. Coming up through this hour, we'll speak to Bob Dole of Crossmark as stocks look to bounce back from Friday's losses. Ed Mills of Raymond James as Doge meets more resistance in Washington. And Holger Schmieding of Berenberg as Germany's conservative leader, Friedrich Merz, clinches an election win. We begin this hour with stocks pushing higher, looking to bounce back following their worst session so far this year. Bob Dole of Crossmark saying Trump has so far done the opposite of Trump 1.0 and policies potentially threaten risk to asset markets. Bob joins us now for more. Bob, welcome to the programme, sir. Bearish start to the conversation this morning. Make it constructive, will you? On Friday, do you think that was the start of a legitimate, justified growth scare in this country, or too much too soon?
No, I agree with you. The potential for a growth scare is sadly for real. You enumerated it's retail sales, it's housing starts, it's manufacturing production, the University of Michigan a survey. All of these things are saying, in just a second or two, we've had some pretty good growth over the last few years. Maybe we're going to take a little pause here. And the only thing you didn't mention, in my view, from investor standpoint is, and valuations. 22, 23 times earnings. They're discounting a world that should be nearly perfect, and it's not. So I suspect we have some risk.
And you say that we have some risk based on the fact that we have high valuations and earnings that aren't keeping pace. How much of this has to do just with where we are in the cycle and how far we've come versus some of the policies that are coming down the pike?
It's a combination of both, sadly. You mentioned the policies. Look, you all been watching the opinion polls. A lot of people who voted for Trump, believe in his policies, are struggling with the pace and method of implementation. And so the polls for Trump are beginning to drop some. I suspect there's more of that to come.
We were talking about what we heard from Stevie Cohen over the weekend, saying that tariffs cannot be a good thing. Some people, like Jamie Dimon of JPMorgan, have talked about how surgical tariffs can be useful. And you hear a whole host of different business leaders really taking it in stride and saying they can manage through it. Where's the truth here?
Yeah, great question. Depends how they're used. Part of the problem, as you all have been inferring, is it's one thing one day, it's another thing the other day. Friday, a week ago, remember the word reciprocal tariffs came up. I got encouraged because, if you and I are trading with each other, you have a tariff on me and I don't have a tariff on you. Reciprocal means I'm going to put a tariff on, unless you say, hey, wait a minute, I'll take my tariff off. So reciprocal tariffs have the possibility of actually bringing tariffs globally down. But that word lasted, about a day and a half, and then we move on to other things.
Well, over the weekend, President Trump said that he's still working on reciprocal tariffs, but the list is very long. We have March 4th when it comes to that pause between Canada and Mexico, March 12th when it comes to aluminum and steel. We get the report on April 1st from USTR and Commerce, and April 2nd we're supposed to get auto tariffs. But all of this potentially could be negotiating tool. What happens if this is just perpetuity of uncertainty when it comes to tariffs?
Well, you use the word uncertainty. Markets hate uncertainty. We all know that. And it comes back to it's complicated. It's requiring further study. It gets pushed out in time. And there are all kinds of trial balloons put up. We just need to take a pause, study this, have some conversations, and not just throw all kinds of stuff against the wall to see what will stick and what won't.
This morning, we also get news that Apple will plan to spend $500 billion domestically over the next 4 years, really a nod to President Trump. Do you think his carrot and stick approach is working when it comes to tariffs on one hand, but maybe better taxes and deregulation if you come into the United States?
It's possible. His intentions are good, in my view. The problem is the world, American businesses can't move on a dime like that and go this way today and that way tomorrow. So it's going to take a little bit of time. But in general, I think that's the approach.
That said, All of this sounds really bearish, but as John was saying, we're not going to dominate the whole show all day, maybe, with some bearish prognostications. You have the likes of Michael Wilson from Morgan Stanley talking about how, given all of what you heard, the U.S. is still pretty good. He said it's premature to conclude the rotation away from the U.S. is sustainable. Mislev Mateka over at JPMorgan having a similar kind of discussion over the weekend. Do you think that everything that you've laid out in this uncertainty really undermines the idea of American exceptionalism, especially at a time where you have Europe that still hasn't gotten its leadership coalitions fully intact?
I agree with your premise. That is, this doesn't get rid of U.S. exceptionalism. What it does is say there are cycles, and perhaps we're in the part of a slowdown in the cycle with all the things you enumerated at the front of the show, again, accompanied by high valuations. So we probably have a period of sidewise consolidation and maybe some pullbacks. Hard to see the market moving up 10% from here.
Hey, Bob, appreciate it. As always, sir. Bob Dole of Crossmark. Looking into an important week. Some earnings from Home Depot, from Nvidia, some data, core PCE, the Fed's preferred read of inflation. And it hasn't been a great start to things over the last month, that's for sure. That move in bonds, yields lower for 6 consecutive weeks. We asked this question with Chris Ferrone earlier on in the month. We asked him whether that supports cyclicals in equities or whether it's something we should be worried about the cycle. And based on what the stock market is now telling us, Friday's session alone, then maybe you should be worried about the economy.
When you take a look at the actual data, you could see that consumer confidence has been falling, and you can argue about the political bent to the University of Michigan sentiment survey, but that's the reason why tomorrow's consumer sentiment data is going to be very important as well. Does it confirm that? On the flip side, there has been this feeling that we've priced in all the good news, and now we're getting some of the anti-growth or the sort of the brakes to growth policies coming out of the White House without a clear sense of how long it will take for them to get some of the tax cuts and the pro-growth policies through.
This can change. It's only February 24th, just to keep us all up to speed. We're going into what, week 5? Is it week 5?
Yeah.
I think it's the fifth week of the Trump administration. It feels like much, much longer than that. Equity futures right now on the S&P up by 0.5%. Some big news out of Apple this morning. Let's give you an update on that and stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Starting in Germany, where the conservative leader Friedrich Merz emerged as the winner in Sunday's election. According to the prelim results, Merz's center-right CDU-CSU alliance won almost 29% of the votes. Merz says that he will form a new government in less than 2 months. In D.C., the Trump administration sent emails to more than 2 million federal workers, ordering them to report on what they did last week or be forced to resign. The deadline to reply is just before midnight in Washington. Elon Musk said the directive came from President Trump. However, several agencies, including the FBI, NASA, and the Pentagon, have asked employees to hit pause on acting on the directive. Now, to that breaking news, Apple has said that it will add 20,000 new workers and produce AI servers in the U.S. The company plans to spend $500 billion domestically over the next 4 years. That will include work on a new server manufacturing facility in Houston and a supplier academy in Michigan. That announcement coming just days after Apple CEO Tim Cook met with President Trump in the Oval Office. And that's your brief, John.
Hey, Danny, thanks for that. More from Danny in about 30 minutes. The words of Tim Cook this morning. We're bullish on the future of American innovation. We're proud to build on our long-standing U.S. investments with this $500 billion commitment to our country's future.
With 20,000 new jobs over the next 4 years, it is the biggest U.S. commitment to date. In new reporting just out this morning, key question here, is this the beginning of more? How much is this trying to placate some concerns by Donald Trump?
Equity futures positive this morning by 0.5%. That stock is down by a little more than 1%. Up next on the program, Doge versus DC.
I think that there are many fine public servants, and if you don't move quickly, then the lobbyists get involved, the entrenched interest, and it's impossible to get anything done.
Can we get anything done? We'll ask Ed Mills of Raymond James next on the program, live from New York City this morning. Good morning. Equity futures positive here, up by 0.5%, bouncing back from the biggest one-day loss of the year so far in Friday's session. That loss driven by much weaker than expected economic data. In the bond market, 6 weeks of lower bond yields on a 10-year maturity this morning, just about unchanged. The 10-year 443.71. Under surveillance this morning, it's Doge versus DC.
I think that there are many fine public servants, and if you don't move quickly, then the lobbyists get involved, the entrenched interest, and it's impossible to get anything done. Anyone who has experienced financial hardship, any kind of the mental duress, I'm sorry for them, but that's also what the average American experiences every day.
So here's the latest this morning. Federal agencies, including the Pentagon and the DOJ, telling workers to ignore demands from Elon Musk's Doge team to justify their jobs after sending mass emails, Musk posting on X, quote, failure to respond will be taken as a resignation. Bloomberg's Tyler Kendall joins us now for more. Tyler, how much confusion was there in D.C. over the weekend? I think we've lost that audio. When we sort out the microphone, we'll turn it up for you. Tyler Kendall there in Washington, D.C., who you could see but could not hear. Certainly some confusion over the weekend regarding Doge. They sent out that email, and I think the email read something like, tell us 5 things you've done over the last week, which maybe works in the world of information technology over on the West Coast. But if you're in particular parts of the US government, you can't actually tell everyone what you've been working on over the past week.
Especially if you work in things that have to do with intelligence and you actually cannot share that to the world. This is classified information, or potentially if you're doing something that legally could be an issue. I will say this is reminiscent of what Elon Musk did with Twitter. Very difficult to do across the federal government, which is why you have a number of people like those of the DOJ, Kash Patel at the FBI, according to the Wall Street Journal, telling employees, sit on this, do not respond. The subject line over the weekend, and believe me, if you want to see the confusion, you can just look into the text messages I received on my phone. Quote, what did you do last week? That's what Trump and Elon Musk want to know.
Well, the other thing, adding to this confusion, is that in the past couple of weeks, the directive from Doge actually said, don't necessarily respond to any of these emails. So it's such a crosswinds of directives at a time where a lot of people are worried that they are going to lose their jobs. Look, to the discussion we were having, it is important to strip away waste. The question is, how do you do it? And whether there is an ultimate goal, and whether you do it with some degree, as you pointed out, of compassion.
Ed Mills of Raymond James joins us now. We can extend this conversation. Ed, welcome to the programme, sir. Hopefully we can hear you, because we didn't hear our last guest. So hopefully we can hear you, so. Ed. Ed, there you are. Perfect. Wonderful. Ed, let's talk about the Doge effort over the weekend, sir. That email that went out. What do you think the consequence of all of this will ultimately be?
So, John, I want you to send me an email by midnight tonight, and if you don't respond, I get $1 million. I think that's one of the responses here in D.C. The question I have with this is that if you go into the executive order that establishes Doge, this is not within their charge. And so you are going to have a series of things, and this is a real issue here in D.C., as to who are you actually reporting to? And if you don't report, are there some legal consequences? Certainly everyone who wants to keep their job is looking for guidance of exactly what they are supposed to do with this under the executive order. Doge is supposed to be working on an upgrade to the IT system and support the chief of staff to the president, Susie Wiles. Doge does not set this out in executive order, but we keep on seeing expansion of that. And until we get some of the legal infrastructure around that, I think there's going to be a lot of quote unquote trauma and uncertainty here in D.C. If you want to shrink the federal government, you can do that. We've seen that in the past. There are processes in place. Clearly, they want to move fast, as you saw Treasury Secretary Bessent say with your interview. However, it is unclear on if you move fast, is it more effective or not?
Ed, we have several government agencies, people that Trump put in place, people that everyone in a lot of mainstream media were calling serious loyalists, telling their employees to leave those emails on red. At the same time that Trump is tweeting out memes, one of SpongeBob SquarePants saying, "This is what I got done last week." Quote, cried about Trump, cried about Elon. If you're an employee at one of these agencies and you want to secure your job, what do you do?
You listen to your manager, because ultimately that is going to be what you kind of have to work with. But there is a lot of uncertainty. And, I think that when we look at kind of some of the, we've discussed the national security issues, the, classified issues, it is very kind of appropriate to have the Director of National Intelligence, Tulsi Gabbard, come out and say to the entire intelligence community, do not respond. There's just certain things that you can't. When you hear from Elon Musk through his posts, some of this is, are there government employees who are not on their email, are not responding to things? That's an appropriate thing to get a pulse check for individuals, whether or not they are engaged in their job. There have been individuals who've been told not to do their job. You look at the Consumer Financial Protection Bureau. There's been a number of folks told, stand down, don't work. So if you're in that position, how do you respond? But I'm also really looking, Annmarie, at what's going to else happen here in D.C. We have a lot of to-dos in Congress this week. We're going to see at the end of the week, are they going to be able to fill out that 5-step thing? Did they pass a budget? Are we moving forward with the tax credits? Are we moving forward with that new defense and immigration spending?
Do you think the House will pass the budget this week?
I'm really skeptical. I think that, we have a situation where one or two members can sink the entire thing. We already have one hard no out there. When we look at this bill, I don't know if there's enough of a crisis or a deadline to get this done just yet. So I wouldn't expect it to kind of go clean on the first start, but almost nothing happens clean on the first start. I am expecting that more attention is going to go to the Senate passed budget. Maybe that provides a quick win for the president on immigration spending, on defense spending, if they need a backup plan, if the House just can't get everyone on the same page just yet.
How much spending that you see being cut from the U.S. government is real versus just sort of theorized about? In other words, how much oxygen have they really saved by making some of these cuts in the federal workforce and announcing cuts to the Defense Department that haven't been approved yet and are sort of discussions at this point?
Yeah, at least at this point, it's very low. A lot of the savings that have been announced are contracts that have actually already been paid. So I want to see more kind of on a go-forward basis, how much that is going to kind of take into account. When we look at Congress, we're not quite sure when they are coming up with some of their budget cuts, how much are those paper savings, how much of those are real savings. I do think, though, there is a lot of momentum of making the tax cuts that passed in 2017 permanent. And I don't think they're going to be able to get $5 trillion worth of pay-fors either through DOGE savings or through some of the savings that Congress chooses. So having this conversation about how aggressive DOGE is being, how aggressive we are going to be on tariff policy is providing political cover and groundwork to actually add to the debt and the deficit over the next 10 years, even when you've had this narrative that there's such a significant reduction in staff and savings of the federal government, Lisa.
Ed, thank you, sir. We're going to leave it there. Ed Mills there of Raymond James joining us on the latest DOGE effort down in Washington, D.C. and a sprinkle of a little bit more. This from Elon Musk this morning, who might be following the conversation, saying the following out on X. Those who ignored President Trump's executive order to return to work have now received a month's warning. Starting this week, those who still fail to return to office will be placed on administrative leave. The latest from Elon Musk this morning.
This is the threat that if you don't get back to the office, you're not going to have a job. Just to let people know, I think about 60% of current employees, federal employees, are already back to the office. There have been others that are part-time in the office and part-time not. A key question about how much resistance this is, and also what kind of grace period if people are not working near their offices.
They've made it a mandate that they want everyone back to the office. Work from home is not going to work under this administration. administration. And you hear that time and time again from the Oval Office, but also the head of those agencies. They want to see their employees, especially if you're dealing with national security concerns, they want to see you using the computers that they have control on inside those government buildings.
They've made that quite clear over the past month, that's for sure. Up next on the programme, Holger Schmieding of Berenberg as Germany's Conservative leader, Friedrich Merz, clinches an election win over the weekend. That conversation up next with the euro at the moment against the US dollar, just about unchanged at 104.69. Live from New York City, you're watching Bloomberg TV. If you are just tuning in, welcome to the programme. Equity futures on the S&P bouncing back from Friday's losses, up by 0.5%. Bigger bounce on the Russell. That's where the big losses were in Friday's session. We're positive by 0.9% there. Closing out last week on the S&P with the worst day of 2025, sending the S&P 500 to the biggest weekly loss going back to January 10th. Friday delivering a whole host of negative economic data, boosting the bond market's fortunes, yields lower across the board. Let's turn to the bond market. The 10-year maturity yields dropping there for 6 consecutive weeks, the longest weekly streak going back to June 2019. Sent the 2-year yield lower last week as well for a second consecutive week. The 2-year this morning, Lisa, 421.51.
You said it earlier, and I think it's important to repeat it, that yields are falling for the wrong reasons. And that's the reason why you saw on Friday the Russell 2000 underperform in the worst day on the S&P 500 going back to late last year. A real question about the services component of PMI coming in contractionary territory for the first time since the beginning of 2023. The prices paid increasing the most since 2022 in that sub-index. A real question here about how much of a realistic read this is through what's to come in the months ahead.
The dollar story has been a weaker one over the last several weeks. We've had 3 weeks of DXY weakness for the first time since September. Let's check out the euro. Euro dollar bouncing only a little bit following the German election over the weekend, 104.67. I think a lot of people stateside just have one very simple question. Does it mean they can spend more? And based on what we've seen on Sunday, that won't be easy.
They don't have the full mandate, and they do have to get some of the fringe groups on board in order to pass some sort of new amendment that removes the debt brake from the Constitution. A real question here about how they do that without making concessions that potentially are unpalatable for the ruling coalition.
We'll catch up with Ollie Crook a little bit later in about 5 minutes' time, who's on the ground leading our coverage in Berlin, Germany. On our radar this morning, federal agencies are advising employees to ignore emails from Elon Musk's Doge team, demanding they justify their jobs. The Pentagon, DOJ and the Department of Health and Human Services telling workers to pause on replying to the emails.
So Elon Musk has this subject line, what did you do last week? And he wants these 5 bullet points to explain, basically justify your position and your job in the federal government. Now, if you want to give some credence to what they're doing, potentially then they could look at what everyone else is doing and see maybe where there's overlap in the U.S. government. The issue is a lot of people in the U.S. government, if they respond to this, it could be illegal. Maybe they can also give away some classified information. So the heads of those agencies are saying, stop, this has gone too far. We need to recalibrate. It remains to be seen then what comes next.
All I can say is Senator John Curtis, a Republican from Utah, said over the weekend, and I want to quote his own words because he is a supporter of Donald Trump. These are real people. These are real lives. These are mortgages. It's a false narrative to say we have to cut and you have to be cruel to do it as well. We can do both. There are ways to improve the efficiency of government without being arbitrary and somewhat mean about it.
We talked about it a few times on this programme, talked about it with the Treasury Secretary. You mentioned it earlier. Are we doing this with dignity for these workers? I've seen some pushback from both sides of the arm, not just Democrats, from Republicans too, as you suggest.
At this point, there is a real question also of what the ultimate goal is and the consistency, the whole concept of due process in law. How do you apply that in a way where there is a predictable framework for the ultimate goal and the process by which it will be administered?
We'll stay on top of the headlines down in Washington for you throughout this morning, including the latest on this effort. The French President Emmanuel Macron set to meet with President Trump at the White House later today. The UK Prime Minister Keir Starmer also heading to DC later this week. European powers trying to secure a role in Ukraine peace talks between the US and Russia.
So united front, I think we're going to see from Emmanuel Macron and Keir Starmer. Our reporting is that actually these two men were coordinating their objectives with a phone call yesterday. So before they went to Washington, D.C., they spoke about what do they really want to hammer home in the Oval Office to President Donald Trump. It's going to kick off actually very soon, in the next 90 minutes. Macron will join Trump as they talk to G7 leaders. Of course, this comes marking 3 years of the war in Ukraine.
I'm curious what the relationship will be between Donald Trump and Emmanuel Macron in particular, because we've heard a little bit of the back and forth between Keir Starmer, but this hasn't been a government that has really embraced some of the stalwart leaders in Europe, especially if they're on their way out. So there is a real question here about what this will look like.
So this is the UK and France, so we still need to put together a government in Germany. We're told they're going to try and do that really quickly by Easter.
Yeah.
Yeah, so on everyone else's clock, maybe not that quickly.
2 months is when they want to put a German government together. When I heard that last night, and I was talking to Oliver Crook last night, we were texting each other, I said, 2 months? They have tariffs to deal with. They have potentially, Trump wants a peace agreement on Ukraine ASAP. 2 months. They're going to be very far behind on where Trump is on his timeline.
The continent could look very different in 2 months. If you haven't seen the results, these are the results. Germany's Conservative leader, Friedrich Merz, and his Christian Democratic Union Party emerging as the winner of Sunday's snap election. But Merz seeing a narrow path to power, partnering with Chancellor Olaf Scholz's Social Democrats, potentially. Joining us now is Bloomberg's Ollie Crook out of Berlin. Ollie, let's start with the results. Any surprises there whatsoever?
Listen, John, I think that overall this sort of came in sort of accordance with what we were expecting. These polls really had been basically unchanged since November when they pulled the plug on the government. And we saw that sort of reflected in the sort of numbers that we got last night. There was a little bit of sort of move around the margins. For example, I was at the CDU headquarters last night where Friedrich Merz gave his victory speech. When the numbers dropped, they came in at about 28%, 2 points below what was anticipated. There was not really a high amount of excitement in the room. And I spoke to a number of lawmakers. They obviously are going with this as a sort of strong victory and that they have a strong mandate. But the reality of the situation is, yes, they are able to build a government with only two parties. This was one of the big concerns for the markets, in the sense that basically you could end up with a three-party coalition that's as clumsy and not as ideologically aligned as the last one, which required them to basically dissolve the government ahead of time. Now they can do it with two. But the reality of the situation is, for those people who are waiting for a sort of fiscal shock and awe, they're going to be waiting potentially a very long time. This is not as straightforward in terms of the CDU being able to get its pro-business agenda through. The SPD, despite having done the worst basically that it's ever done in its history, now is still holding quite a few cards because they are really the only viable coalition partner for the CDU. And as you were just pointing out, we are talking about a moment here where in the United States, Donald Trump has been president for only about a month. Think about what another 2 months means, and if that is the amount of time it's going to take to get a government in Europe's biggest economy.
Especially when you have Friedrich Merz coming out and saying that this American government, at least, quote, are largely indifferent to the fate of Europe. And he said the world will not wait for us. So then why are they waiting 2 months? 2 months in a Trump news cycle, Oliver, I don't need to tell you, is basically a lifetime.
Listen, I think that you could take this as emblematic to some of the larger problems with the German economy, right, which is basically sitting a little bit further back and not being proactive. You see it with the auto industry. Why wasn't the German auto industry one of the most proactive to electrify and be ahead of the curve? They were being a bit complacent. This is a bit the story politically here for Europe. If it's going to take 2 months to put together a government, it could even take longer, right? This is a sort of optimistic timeline for them. And the reality of the situation is, though, for Friedrich Merz, despite the fact that he did tack a bit more to the right, certainly on the issues of immigration, in order to try to sort of pull support from the AfD. As far as Europe is concerned, as far as solidarity within Europe, Friedrich Merz is very pro-Europe. He's a former MEP. He's sat in the European Parliament, and he's been sort of emphasizing that overnight, basically saying that Europe needs to try to get a seat at the table, but basically they can't ever get that seat by begging. Those were his messages yesterday, and that basically you need to have a much more unified Europe and a much more strong Europe. The question is, how do you achieve that if you're not willing to move on some of the stimulus domestically? And again, the big question, will he eventually be forced to go to Brussels, talk about joint debt, potentially to get that defense spending up? That still seems like a distant prospect, but that could be a way to make a major step forward, and for Germany, frankly, to have a very large hand in shaping the future of the European Union.
Ollie, appreciate the update over in Berlin, Germany, following the election results yesterday evening. Joining us now to extend the conversation, Holger Schmieding of Berenberg. Holger, as you know, a lot of investors stateside just have one question. Will this mean Germany can spend more? So I'll ask you that one question, Holger. Will the results over the weekend complicate that effort?
The results actually complicate this effort because we now have the parties at the extreme, at the right-wing fringe, of the spectrum and the left-wing fringe of the spectrum. We have the AfD and the Left Party, together with more than 1/3 of the seats in the federal parliament. And that means these two parties can veto any change to the constitution, can veto any change to the German debt brake. And so this is a result that was possible, but that did, according to opinion polls, not look like the most likely outcome. It doesn't really matter that much whether Friedrich Merz and his party got 30% or 28 point something percent. What matters is, do they have scope for a serious change in fiscal policy? And that is now even a bit more difficult than it seemed before, because to get either the AfD, a party to which nobody else wants to talk, or the Left Party to agree to a reform of the debt brake would be very difficult. For example, the Left Party would love to issue more debt, yes, but exactly for the wrong purposes, for more welfare. They would like to keep borders open, exactly the opposite of what Merz wants, and they would like to cut defense spending, exactly the opposite of what Germany needs. So finding an agreement so that parties, all in all, with more than 2/3 of seats in the Bundestag, do actually vote for a reform debt brake is going to be very, very difficult.
So, Holger, without the reform of the debt brake, what kind of fiscal space does Germany actually have?
Well, there are ways around it, of course. For instance, Germany could declare a national emergency by a simple majority in parliament. Problem is that national emergencies are by their very nature temporary. You cannot put the long-term secure funding of the military on a safe basis by having an emergency. There is a small chance that if the Germans are really, really fast, that the outgoing parliament, where there would be a majority for the parties that might possibly want to reform the debt brake, that this old parliament still does it, but there are serious legal technical hurdles ahead of that. And as already mentioned, one way around this would be to have the European level finance more, but that with an unchanged German constitution would also not be easy, or more precisely, would have to be very specific, would have to be limited, because otherwise, for simply a lot of Eurobonds for a long time, the German Constitutional Court, judging by how it has ruled in the past, would also say no. So the German fiscal situation is complicated. There are ways to raise federal spending, but it's not easy.
What are some of the concessions that the ruling party would have to make in order to get some of the fringe parties on board to pass either an amendment, that 2/3 required to pass an amendment to remove the debt brake, or to, as Friedrich Merz promised, achieve independence from the U.S.?
Well, to change the debt brake, you do need this 2/3 majority. And sort of, as I tried to say, to get the Left Party on board is very, very difficult. They would like to ditch the debt brake, unlike Mr. Merz, who might possibly want to just reform it. But the Left Party wants to do exactly the wrong things with the money, and to get them to agree to doing the right things with the money. That is to have a pro-disarmament party agree to a major lasting rise in military spending, and that for a purpose, confronting Russia and Ukraine, that this Left Party does not share, would be very difficult. And if Merz had to compromise on his pro-growth reforms, for instance, by having more welfare and higher taxes on the rich rather than the opposite, that would compromise his urgently needed pro-growth agenda. So once again, it is possible, probably. There are ways around this debt brake issue, but it's going to be complex and not easy and probably not fast.
When you put it all together, Holger, are you more optimistic or less optimistic than you were on Friday about the prospect for the German economy in the next year and 2 years ahead?
Relative to what the opinion polls had projected on Friday, I'm slightly less optimistic. I remain optimistic that Mr. Merz will be able to implement pro-growth reforms, but it will be more difficult rather than easier for him to actually get the fiscal space for the things that need to be done, such as business tax cuts and secure long-term funding for the military. These are serious questions ahead.
Holger, appreciate your input, sir. as always. Holger Schmieding there of Berenberg. President Donald Trump has been pretty consistent on the issue for much of the last decade. He's been justified in making the pushing the Europeans to do more for themselves. The effort over the weekend, the outcome of that election, it's going to complicate that push.
Because it's going to be that much more difficult to remove the debt brake. I love what Mario Draghi said a couple of days ago. You can say no to public debt. You can say no to the single market. You can say no to create a capital market union. You can say no to everything. But at a certain point, what are you going to do? And he's saying, I have no idea, but do something. And that, I think, is what a lot of people are wondering, how that's going to happen.
Listening to Holger, it sounds like it's going to be a lot harder for them to then increase military defense spending. And that is going to infuriate Donald Trump, because he has made it crystal clear in Trump 1.0 and now coming to Trump 2.0, he wants an even higher NATO defense spending per each of these countries, maybe as much as 5% of GDP. How does Germany do that if they don't have the fiscal space?
That push will continue, that's for sure. If you are just joining us, welcome to the programme. Equities bouncing back from Friday's losses, higher by 0.5% on the S&P 500. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Shares of Berkshire Hathaway are higher by 1.1% in the pre-market trade. Over the weekend, it reported earnings, with operating earnings surging 71% in the fourth quarter. Buffett's cash hoard also grew for a 10th quarter in a row, now standing at a record $334 billion. Ukrainian President Volodymyr Zelensky says that he is willing to step down if it means peace and NATO membership for his country. Zelensky says it's clear that he wouldn't be in power for decades and would happily make that trade if the offer was made. Pope Francis remains in critical condition as he continues to battle severe pneumonia. The Vatican says that the 88-year-old pontiff is still receiving high-flow oxygen to help with his breathing. Some blood tests show an initial mild renal failure, which is currently under control. The Vatican says the Pope continues to be alert and well-oriented. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, bracing for higher prices.
If tariffs raise inflation by 0.5 point and we end up with 2.9% inflation, it may be that Americans aren't really noticing it quite as much as they did a couple of years ago, but the Fed will certainly be noticing it.
We noticed it on Friday in the UMich survey. How reliable is that economic data? We'll get to that with Nela Richardson of ADP in just a moment. From New York, this is Bloomberg. Good news if you're working for Andrea Orchel over at UniCredit and you're a top manager. He's lifting the bonuses for top managers by 11% after a record year. All right? So just sprinkle of good news out there.
I feel like 5 people with little, celebratory hats and yay.
Might be hungover after a long weekend. I don't know. Equity futures right now positive by 0.5% on the S&P 500. In the bond market, yields just about unchanged. 443.90, this run of gains we've seen. 6 straight weeks of lower yields on a 10-year yield. The economic data was not good on Friday, and that contributed to the move going into the weekend. Under surveillance this morning, bracing for higher prices.
If tariffs raise inflation by 0.5 point and we end up with 2.9% inflation, it may be that Americans aren't really noticing it quite as much as they did a couple of years ago, but the Fed will certainly be noticing it. The Fed's not cutting rates in a world with inflation like that, and in fact, it might even be raising them.
So here's the latest. UMich sentiment showing consumer inflation expectations jumping to their highest level in almost 3 decades. Survey responses, mostly along party lines, showing new inflationary concerns about President Trump's tariff policy. Joining us now to break it down, Nela Richardson of ADP. Nela, good morning.
Good morning.
Got to start with you, Mitch, on Friday. How reliable is that economic data? How much weight should we put on that?
I think it gives you good situational awareness. Should you create monetary policy around it? No, I don't think so. But in terms of where the consumer is going, what they're thinking, and tracking that every single month, I think it gives you a benchmark or at least some context for how consumers are feeling. We can't interview every person on the street. If we could, we get, more real-time data, but it's a survey. There's luckily other things from the Fed about consumer expectations from the New York Fed and other Fed banks that we can also use to support this data. But I think if we take from it that consumers are still feeling inflation, and it's dampening their sentiment. I think that's a great piece of information to move forward to and think about the economy in a broader context.
We've been pretty bearish. I've gotten a couple of emails, people saying, really, this is coming back. And on the flip side, there's a lot of optimism among businesses. See, I'm actually being positive here. And even though you have consumers that feel negative, the optimism among small businesses has skyrocketed. So which is more important to hiring and to the overall economy? If people have jobs, what they do and what they say are going to be different things.
What they do and what they say are different things, and I think it's a matter of timing because feelings do translate into action. And if consumers are feeling bearish about this economy, it matters for hiring because it's a consumer-driven economy. Consumers are driving the industries that are surviving and thriving right now: leisure and hospitality, healthcare, which includes a lot of discretionary procedures as well, like dental work, for example. So, we can't discount the consumer mood and the consumer vibe. At the same time, it's encouraging to see small firms feeling optimistic because small firms are the engine of growth for the economy. So what are they optimistic about? I think they're optimistic about perhaps lower interest rates, lower financing costs, maybe an easier hiring environment vis-a-vis larger firms who have outmanned them in recruitment and talent. And maybe there's a feeling of less regulation going into this new year, new administration, that gives them some tailwind to their spirits, so to speak.
Is there a sense that the negativity in consumer sentiment can persist for a very long time and it not be felt in the broader economy? And I say this because there was a data out of Moody's that said that the top 10% of U.S. earners now account for about half of all consumer spending, that actually in the period, in the year ended September 2024, they increased spending while the rest of the earners decreased spending. Can this continue for a while because people at the top are feeling pretty good?
As long as asset prices hold up. So if you are a wealthier consumer, some of your optimism and your spending patterns are based on the fact that assets have been really strong over this time period. So while lower income consumers are feeling inflation in a very visceral way. I mean, I was in Louisiana where the price of eggs were over $10 because of the bird flu. You're going to feel that as a low-income consumer. But if asset prices stay strong, you may not feel the same pinch as a high-income consumer and can keep, that fluidity in that spending. But yes, the fact that this is a lopsided consumption market is a very real thing. If asset prices turn sideways, that changes the dynamic for the economy.
That's a tough anecdote and something this administration or any administration, Biden, Trump, very challenging to do because what's going on with the bird flu. Something else that struck me with the University of Michigan survey was that more than half of consumers expect the unemployment rate to rise over the next year. Do consumers think they might be out of a job?
We're seeing that in the turnover rates. There is some anxiety, perhaps, on the worker side. I mean, everyone's seeing the headlines on the federal government and what's going on there, but we don't really talk about what that could mean for the private sector. And from what I'm hearing anecdotally and what I'm seeing in the ADP data, and we've saw that before the new year and the new administration, is that people and workers are staying put. There's a sense that the economic prospects, the job opportunities aren't as plentiful as they were 2 years ago. It's taking longer to get a job. It's taking longer to find a white-collar job. We've seen business services retract their hiring. New college graduates are taking longer to get a job. And there's a sense that maybe I should stay with the employer I have. Also, with the Great Resignation, a lot of people switched 2 years ago and they're not ready to move. So that turnover is having an effect on the labor market, and it's leading to the stasis that we're seeing. It's like the quiet before the storm in some sense.
Andrew Honhorst of Citi talked about the same thing, this low churn dynamic in the labour market they think is inconsistent with a healthy labour market.
If the market is strong, you should be able to quit your job. And that's why people are watching quits come down to some of the lowest levels since the pandemic. And that's the reason why some people are saying it could portend something less positive.
Focused on jobless claims as well at the moment, aren't we? Every single Thursday at the index level, things are still OK. Beneath the index, just focused on Virginia, Washington, D.C., certain places, are things starting to break.
And people put out reports over the weekend of the proportion of federal workers that work in the D.C. area. It's about 20%. So people are going to be looking at specific counts in specific counties to try to understand how this is trickling into numbers to get a broader sense of how to even frame this in conversation.
The estimate for Thursday morning, by the way, is 221. The previous week was 2 19. Nela, good to see you. As always, thank you. Nela Richardson there of ADP. Up next on the programme, Matt Stucky of Northwestern Mutual, Henrietta Treyz of Veda Partners. We'll catch up with the former senior advisor to President Biden, Amos Hochstein, and Earl Davis of BMO.
The starting level of yield is still quite attractive, and risk assets are still quite rich.
We still believe that the Fed is much more sensitive to labor market weakness.
If the labor markets really deteriorate, we would expect the Fed to react in a strong way.
The single most important economic data point right now is unemployment claims.
35,000 feet, the labor market still looks really good.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City, the second hour of Bloomberg Surveillance starts right now, and your week ahead looks like this. It concludes with the Fed's preferred read of inflation, core PCE. That comes on Friday. Lots of earnings in between, two big ones. The big one is Nvidia on Wednesday. But look out for Home Depot on Tuesday. Some reads around the US consumer. Not satisfying. Disappointing on Friday. Let's see if that continues. And that was reinforced by the weaker outlook from Walmart as well last week. That dragged US stocks lower, the biggest one-day loss on the S&P 500 so far this year. Equity futures bouncing back by just 0.5% on the S&P 500 this morning. Big losses on the Russell. Going into the weekend, we bounced back this morning, Bramo, by just 0.8%.
I like how you framed both Home Depot and Nvidia. They're two pillars of the American exceptionalism story exemplified. On one side, you've got consumer spending, albeit challenged in the housing sphere with Home Depot and some of those renovations. But then in Nvidia, this idea of how much can chips and the AI hope and dreams that we've seen really power that U.S. exceptionalism. To me, that might be the key moment for markets that are still hinged on the idea that U.S. tech can keep outperforming.
When it comes to the consumer, how much are they concerned with the tariffs that right now, only thing we have certain on is the 10% on Chinese imports? There's a long list of diary dates we need to keep an eye on in terms of whether or not these tariffs are going to come into play. Walmart, in their outlook, acknowledged that there are still uncertainties related to consumer behavior and global economic and geopolitical conditions. Without saying it, they said it. They are unsure about what the tariffs could mean, even if it is going to be a one hit on inflation and prices.
Sentiment was sky high coming into 2025, particularly for small and large businesses. For the C-suite, for CEOs, we said repeatedly on this program, we don't want to see that squandered. We want to see some follow-through, some investment decisions, some hiring decisions. We get some of that from Apple this morning, with Mark Gurman reporting suggesting Apple will hire 20,000 new workers and produce AI servers in the United States. The company plans to spend $500 billion domestically over the next 4 years. So how does this compare to previous plans? Mark's saying this, that Apple is going from investing $86 billion a year to $125 billion in the United States, and from hiring 4,000 R&D employees a year to 5,000 based on its prior 5-year commitments compared to the new 4-year commitment.
Back in 2021, Apple released a statement saying they were going to invest about $500 billion and hiring some 20,000 people in the United States, reaccelerating. This sounds like it's bringing it forward. A key question here is, how much does this really highlight what we're going to see on an ongoing basis, which is companies sort of gussying up some of their ideas and their plans to try to curry favor with the president without us getting a sense of how much this is a difference from what was announced and what was planned, say, a year, 2 years ago.
Who's the audience for the announcement? Investors on Wall Street or politicians down in Washington, D.C.?
Given they already announced such a big chunk of this years ago, to Lisa's point, this feels like icing on the cake with an audience of one, and that's Donald Trump. And guess what? He already told us on Friday when he was speaking to a group of governors that he had left a meeting with Tim Cook and he plans to do this. Why is Apple doing this? That's the question. Probably because, like in Trump 1.0, they're looking for carve-outs when it comes to tariffs.
The Wall Street Journal wrote an editorial over the weekend, and the first line of it I thought was applicable to a lot of different announcements and things we've been hearing. The Trump administration is moving so fast, it's hard to know what's real and what is a media panic. It is hard to know what is actually concrete and different from before versus something that is simply signaling. And I think that is what we're going to be trying to figure out for a while.
There's always a lot of media panic. Always. There was 8 years ago, right?
Yeah. Well,
panicking about just about everything.
Right. And so at this point, it's hard to know what's real and how much this is actually going to be carried through on all sides, whether it has to do with job cuts, whether it has to do with investments.
We're going into week 5. Just week 5. The way people talk about it, it's like we've been doing this for months. It's week 5. Coming up on the programme, Matt Stucky of Northwestern Mutual looking ahead to NVIDIA results. We'll catch up with Henrietta Treyz of Veda Partners on the odds of one big, beautiful bill and the former senior advisor to President Biden, Amos Hochstein, on securing peace in Ukraine. We begin this hour with stocks looking to recover their worst day of the year. Traders awaiting NVIDIA earnings on Wednesday and core PCE on Friday. Matt Stucky of Northwestern Mutual writing, mega caps are ploughing into AI. It's a big tailwind for near-term economic activity and long-term productivity. Matt joins us now for more. Matt, welcome to the programme, sir. Is it a big tailwind for NVIDIA?
Well, it certainly is. And if you're looking at kind of what the hyperscalers are spending money on, it is NVIDIA chips. And so, ratcheted up CapEx expectations as you look to 2025 and what's been happening in the last few years has kind of falling directly into NVIDIA revenues, and we expect that to continue.
How crucial is the NVIDIA report on Wednesday, Matt, to really give fuel to this story that we've seen about big tech really being the center of the AI dreams and hopes and continuing its meteoric rise?
Well, it's a large piece of the S&P 500, as you know. And then when I came in this morning and was looking at the eco function on my Bloomberg terminal, I didn't see the NVIDIA earnings report listed there, but it might as well be on that number just in terms of its importance in the U.S. economy and its overall kind of impact and what separates the U.S. economy from the rest of the world. In terms of kind of the earnings story of the United States relative to the rest of the world, it has been driven by big tech, and NVIDIA is a huge component of that.
Matt, just more broadly, we started this show on a pretty bearish note, people talking about what happened, people meaning us, what happened on Friday with some stagflationary data in a sense that momentum was hitting the pause button. How much do you see this as just sort of a momentary blip versus a real shift in narrative that's affecting how you plan to position going forward?
I think, Lisa, I would classify this more as churn versus trend as it relates to kind of what we saw in late last week. And really, if we're kind of on lookout for sources of corrections, really there's two I would point to. One is a ratchet up higher in interest rates or a ratchet up higher in unemployment. With the labor markets, somewhat resilient here, and the forward indicators, whether you're looking at small business confidence, the Conference Board hard easy numbers, or overall just the consumer spending profile, which has been firm, outside of kind of some softer retail sales in January and so far. Looking at what's left in terms of correction possibilities, it's interest rates is where you're looking at. And in my mind, if we have a little bit of a softer start here in Q1, I think that helps kind of keep the interest rate kind of upside breakout potential somewhat more muted. And to me, so this is kind of more of a consternation, more of a churn dynamic versus more of a trend, if you want to call it that. Just looking ahead, I would say, January, again, you look at one of the coldest Januaries we've seen in more than 130 years. I think that really impacts some of the spending numbers and some of the softness we've seen so far.
Matt, there's a note this morning from an analyst about Microsoft that they think will be canceling leases for a substantial amount of data center capacity in the United States. That begs the question, and potentially, are you cautious about this, about the outlook for demand when it comes to AI? NVIDIA to me has a large list of customers, Microsoft's being, a big spender in the AI story. But look, in terms of kind of what else is out there in terms of the overall kind of investment, we've heard from Meta, we've heard from Google, we've heard from Amazon, ratcheting up CapEx expectations, and the announcement this morning from Apple also confirming their desire to continue to build out AI compute capacity. Of course, you're always kind of looking at the risk that there's some cyclical correction in terms of AI compute demand if, for whatever reason, we don't see the follow through in terms of productivity enhancements roll out to the broader set of the economy in the coming years. But as it stands today, the checks into the NVIDIA quarter were very strong, and the product transition moving from Hopper over to Blackwell seems to be kind of moving forward fairly well. Do you think there is still, though, this nervousness or angst in the AI space when it comes to what China is doing, the money that they're throwing at their AI development?
I think that it's certainly a risk that's out there. It's not as much of a direct risk, though, for NVIDIA's revenues. With export restrictions that are in place for U.S. semiconductor companies selling into China, higher competition there means that U.S. companies also need to be aware of that competition and spend more on their own AI roadmaps to compete with China. To me, I don't think that's necessarily a direct negative for the overall kind of AI story. It just means that there's more competition, which to me means more spending.
Hey, Matt, appreciate it. Looking ahead to those earnings on Wednesday. Matt Stucky there of Northwestern Mutual. NVIDIA results drop in on Wednesday after the close. Look out for that. Data-wise, looking out for jobless claims later this week and PCE, the inflation read for the Federal Reserve on Friday. Got to pick up on this bond move, though, over the past 6 weeks or so. 6 consecutive weeks of falling 10-year yields. And I'll go back to that question that Chris Verona strategist asked on this programme in the last few weeks. The lower bond yield support cyclicality or suggest growth is slowing? On Friday, I think we got a definitive answer for that session alone.
Which is unfortunate when paired with this sense that maybe inflation is going to be a bit more sticky, which is the reason why you're seeing yield curve flattening. And if you get that continued sense, it is absolutely a negative thing for a lot of equities, which is what we saw with the Russell 2000.
The complete opposite of what people were expecting closing out 2024, kicking off 2025. Yields down every single week of the presidency so far. Not up, lower.
This has to do with two things. First of all, we're getting some of the tariffs and some of the less growth-focused policies from Donald Trump to start the year. We also are just entering a later cycle of this economic period. But then on the flip side, there's a real question here of what some of the offsets will be, what some of the investments will be, and how much people can make those given some of the uncertainty.
Bond yields just a touch higher this morning, up by close to 2 basis points at the front end of the curve. Let's call it 421 on a 2-year yield. On a 10-year, just about unchanged at 444. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ukrainian President Volodymyr Zelensky said the U.S. dropped its demand for Kyiv to pay $500 billion to compensate for prior U.S. support. That demand had been part of the talks to give Washington a cut of Ukraine's mineral wealth. Zelensky insisted, though, that U.S. military support must be part of any deal. He went on to reject the U.S. argument that American companies doing business in Ukraine would serve as a form of security guarantee. Over at UniCredit, the bank is increasing its bonuses for top managers after a record year. People familiar say the bonus pool for so-called material risk takers will increase by 11%. The Italian lender is also planning to raise the average bonus for staff by 20%. Researchers at the Wuhan Institute of Virology in China say that they've discovered a new coronavirus in bats that enter cells using the same gateway as the virus that caused COVID-19. According to the journal Cell, the finding raises the possibility that this new virus could spread from animals, though it has not yet so far been detected in humans. And that's your brief, John.
Danny, thank you. Appreciate it. Kinda, with the exception of the last story. How many people turned around on Friday and over the weekend when they read this for the first time and just said, nope, not doing that?
Literally, that's exactly what I was going to say. My oldest son turned to me. He's like, if there's another lockdown, I'm not doing it.
Close the laptop. Don't want to read about it. Don't want to hear about it.
Not having anything to do with it.
Basically, we can't do this again. And the market was saying, well, maybe we should.
Well, we'll talk about it
exactly.
in about 60 minutes from now. So maybe you want to turn down the volume. Geoff Meacham, Global Head of Healthcare at Citibank, joining us on some of the vaccine makers and the latest story out of China. Up next on the program, attempting to secure peace.
Standing here and saying, you're good, you're bad, you're a dictator, you're not a dictator, you invaded, you didn't, it's not useful, it's not productive. And so President Trump isn't getting drawn into that in unnecessary ways. And as a result, we're closer to peace today than ever before.
Bloomberg's Tyler Kendall joins us next in the nation's capital, live from New York. This is Bloomberg. So this right here is your bounce back in equities. We're up by about 0.5% on the S&P so far this Monday morning. In the bond market, yields just about unchanged. The 10-year 443.71. Under surveillance this morning, attempting to secure peace.
My question is, does all the finger pointing and pearl clutching make peace more likely? Standing here and saying, you're good, you're bad, you're a dictator, you're not a dictator, you invaded, you didn't, it's not useful, it's not productive. And so President Trump isn't getting drawn into that in unnecessary ways. And as a result, we're closer to peace today than ever before. And I've been privy to these conversations. great progress is being made. Zelensky should come to the table because this economic partnership is an important thing for the future of his country.
So here's the latest. Defense Secretary Pete Hegseth avoiding calling Russia the aggressor in the war in Ukraine. The United Nations is set to vote today on separate resolutions to stop the war drafted by Ukraine and the United States. Bloomberg's Tyler Kendall joins us now for more. Tyler, it's a new approach from a new administration.
Right, John. Well, it's also the latest example of what has become strained transatlantic relations with Washington. And we could see one of the first meetings here in Washington today from these rising tensions when French President Emmanuel Macron visits the White House. President Trump criticized the French president as recently as Friday, calling him a friend, but saying that he's had a seat at the negotiating table when it comes to Ukraine for the last 3 years, of course, a sentiment that has been met with widespread criticism among our European allies. Now, the French president did preview some of what he might tell President Trump, saying that any concessions to Russia could be viewed as a sign of weakness and that he would tell President Trump, quote, that is not your trademark style. We also know that he is expected to tie what an emboldened Russia in his terms could mean for an emboldened China, of course, another one of the White House's priorities. But, John, really, this Trump administration looking for firmer European-led security guarantees, as well as a boost to NATO defense spending. If we keep on France as the example, of course, France spends about 2% of its GDP when it comes to military spending, a number that this White House would like to see higher.
Tyler, we've seen Emmanuel Macron fail in the past with Trump, trying to keep Trump 1.0 in the Paris Climate Accord, trying to keep Trump 1.0 in the JCPOA when it comes to the Iran nuclear deal. What is his strategy going into this meeting today with the president?
Right. But also, of course, we did see the French president invite President Trump in one of his first visits after he was elected to Paris for the reopening of Notre Dame. We do know that the French president is coordinating closely with his UK counterpart, Keir Starmer, who is also expected to be here in Washington later this week, and that we are expecting the pair to put forward that they are ready to up those security guarantees. You heard in that sound played earlier there that this White House is looking particularly for Ukraine to sign that deal when it comes to an economic cooperation agreement and opening up Ukraine in order to be able to get their critical minerals. That is also something that we are expecting to be discussed this week in Washington as these European allies try to push the Trump administration to give forward some sort of guarantee that they will remain in the region moving forward. It's something that we saw became a big point of contention during the Polish president's visit over the weekend when he met with President Trump on the sidelines of CPAC. He did emerge from that meeting saying that he had a sense that President Trump was not going to pull troops, at least out of Poland, of course, the closest ally to Ukraine's border.
Tyler, appreciate the update down in Washington, D.C. Tyler Kendall there in the nation's capital. Here's an update on the latest from Apple. If you are just joining us, some news about 1 hour and 20 minutes ago that Apple will hire 20,000 new workers and produce AI servers in the United States. The company planning to spend $500 billion domestically over the next 4 years, including work on a new server manufacturing facility in Houston and additional spending with its existing suppliers. What does this mean relative to what we've already heard over the last several years from Apple? Mark Gurman, our star reporter here at Bloomberg, saying that Apple is going from investing $86 billion a year to $125 in the US and from hiring 4,000 R&D employees a year to 5,000 based on its prior 5-year commitments compared to the new 4-year commitment announced this morning. The president responding to that new commitment saying the following: Apple has just announced a record $500 billion investment in the United States. The reason? Faith in what we are doing, without which they wouldn't be investing 10 cents. Thank you, Tim Cook, and thank you, Apple.
So this goes to the heart of the question: how much is this actually a massive ramping up of Apple's plans versus signaling to President Trump saying, look, we're doing our part. You can celebrate this as a win. Now you can not penalize us potentially for doing business outside the U.S. and having production in China.
This is a slight acceleration of prior investments, how Mark Gurman talks about it on Twitter, from their April 2021 announcement of how much they were going to move some jobs and investment into the United States. But for Donald Trump, he is going to sell this as a record brand new investment. It's not. There's a little bit of nuance and a caveat we need in this truth, which we're not exactly getting.
To extend the conversation, Henrietta Treyz of Veda Partners joins us now for more. Henrietta, the objective of this administration has been pretty clear on the economic front coming into power. They were going to make life very easy and very simple if you invest in America and difficult if you're trying to export into America. Apple's making an investment decision this morning to invest more on the margin, to hire more on the margin. To help that a little bit more, they talked about lowering the corporate tax rate. Henrietta, where are we on that front? And what's the timeline for the tax bill now?
Great segue. I didn't see that coming, but happy to talk taxes. The corporate tax rate reduction is something that scores really well from a dynamic perspective, meaning when the House Republican Conference released its budget, they are telling the American public that keeping taxes at their existing rates for individuals will boost the U.S. economy by $3 trillion. They're not going to get a score from any government official or JCT or CBO that suggests that that's remotely true. The real number is somewhere $379 billion, if I recall. But if you're able to cut the corporate rate or bring any tax preferences for businesses into the equation, you do generate more dynamic scoring. So it's expected that you'd hear jawboning about reducing the corporate rate. Every percentage point costs $150 billion. They're already $500 billion short of where they need to be. So my expectation is very low that we see a corporate rate cut going into the tax bill this year.
Well, if they want to get to the corporate rate cut, they got to start somewhere. If they want to lower it, will we see potentially this budget deal that Mike Johnson is going to be back in Congress this week? Will he put it on the floor and will it pass?
Yeah, that's the question of the week for sure, Annmarie. The expectation is that tomorrow night, beginning somewhere after 6 p.m., he's going to bring the House budget as it stands right now to the floor. Now, this budget is going to need to go through the Rules Committee, but once it gets to the floor, you have members who have heard an earful from constituents all week long. And that is from, Texas to Pennsylvania. Members who are very concerned about the $880 billion in Medicaid cuts. When you have representatives from states like Minnesota, for example, 21% of their constituents are on Medicaid. So $880 billion worth of cuts from energy and commerce is going to hit them. There's massive cuts to Pell Grants, as well as SNAP and TANF. Members have serious heartburn in both the House and Senate on this legislation. And the public outcry from members is what you really want to watch. And there have been members who are very willing to go on the record, from Susan Collins in Maine to John Curtis in Utah, saying, hey, this bill is not ready for prime time yet.
Can they cut from the Commerce Committee without hitting Medicaid?
Not at $880 billion. There is not a way. So what you want to look at is the tiering of what is possible from Medicaid. My colleague Spencer Perlman is our healthcare expert, and he thinks the work requirements are the lowest hanging fruit. That's about $120 billion in revenue. You're still going to need more than that if you need to get $880 billion from E&C. So they're going to need to be looking elsewhere. The Senate Republicans are saying, hey, I've got a better solution. Increase the deficit by more. So we'll see if the House Republicans can address that.
Over the weekend, Henrietta, there were a number of reports about Republican representatives getting angry responses from constituents. And then I looked at the popularity of Donald Trump and some of his policies being at some of the highest levels of his administration, and certainly much higher than going back to his previous tenure. I'm just wondering, where's the truth here?
Yeah, cuts for thee, but not for me. I think that Donald Trump personally remains extraordinarily popular. People like the disruption that he's bringing to Washington. The culture wars are very much a part of his appeal. You saw it on display in Maine earlier this weekend, talking about transgender sports. So there is a incredible salesmanship that goes on in Trump's ability to connect with his voters that is entirely distinct from his actual legislative policies and the Republican platform, which across many provisions, including these cuts, is unpopular with constituents. So I think we've said this before on the program, but reducing the deficit is popular. Cutting spending is not. And that's something that they're going to have to equate with and take those tough votes. And that's why it's harder to be a House member than an executive.
Framing matters. Henrietta, thank you. Appreciate it. Henrietta Treyz there, Veda Partners, the latest on the tax bill. He's done exactly what many people voted for him to do. Wall Street spooked, and I use the word spooked loosely because we're still very close to all-time highs on the S&P. I'm talking about Friday directly. Wall Street was spooked on Friday because of the sequencing. Tariffs have come before taxes. And if we did this the other way around, like we did in the first term of President Trump, I think you'd have a different result.
Which is the reason why Bob Dole said he's doing exactly the opposite of what he did in his first term. I think it's right that you bring up Home Depot. We had Walmart and some of the expectations from them coming down, dampening because of tariffs. Do we get the same from other types of corporate executives? That could change the tone.
The housing data has been pretty awful.
Yeah.
That's for sure, including the numbers on Friday. Coming up on the programme, I saw him walk into the building out the corner of my eye just moments ago, already looking 10 years younger. Amos Hochstein, the former senior advisor to President Biden for energy and investment, joins us in just a moment. From New York City, this is Bloomberg. Equity futures bouncing back from Friday's losses. We're positive this morning by 0.5% on the S&P 500. Losses on Friday on the Russell, pretty dramatic, down by 2-3 percentage points. The Russell this morning up by 0.8%. With 2 hours until the cash open, let's get you some morning movers. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. We start with a big story here. Apple investing big here in the U.S. Shares are lower, though. So I asked Dan Ives earlier why this is happening, and he said that this knee-jerk reaction is on the premise that Apple will diversify away from China. But he says it's the wrong reaction because it's just a doubling down on the U.S., and it's a way for Apple to get on the good side of the Trump administration. We have seen shares recover a bit from their initial drop, so the market may be coming into that view as well. Next up, we have Nike shares. Those are up 2.2%, and that is after analysts over at Jefferies upgraded the stock to a buy. They say the new CEO, Elliott Hill, has the right playbook. Not only is he engaged with current and lapsed partners, retail partners, he also says that they also see that he's driving innovation, and they say that you saw that last week with their announcement of their Skims partnership. And last up, we have Domino's, the pizza chain, getting hit here in the pre-market, down about 4%. Same-store sales here in the U.S. missed estimates, and it just shows how difficult it is to entice those budget-conscious consumers that, of course, Domino's is targeting. John?
Yahara, thank you. That stock is down by 4%. More from Yahara a little bit later on this morning. Lululemon and Lewis Hamilton partnership coming up as well, apparently. That was teased over the weekend.
Lewis Hamilton, really? Are we going there? I will just say this. Increasingly, it needs to have the star power behind it in order to get.
John loves him now because he drives for Ferrari.
I know.
So everything's going to be Lewis Hamilton.
I'm not embarrassed or ashamed of that. Obviously, Ferrari first, and then whoever sits in the seat, you back them.
All right, so you're going to put on a Ferrari jacket? Is that what you're going to wear tomorrow? With
Possibly.
a skinny tie?
Like when the season
with
starts,
Lululemon.
yeah.
With Lululemon pants.
On our radar this morning, several government agencies telling their employees to ignore demands from Elon Musk's Doge team to justify their jobs or face dismissal. The Pentagon and Department of Justice citing potential legal pitfalls and agency autonomy.
Legal pitfalls as well as potentially national security issues. What if you work at the CIA or the FBI, which Kash Patel, according to the Wall Street Journal, he's the newly confirmed FBI director, also telling employees to please pause any response to Musk's note because this could create more problems than find solutions. I will say, though, my phone was blowing up all over the weekend. There's more than 2 million federal workers who received this email with the subject line, "What did you do last week?" And then on top of that, they felt like they were being trolled by the president, who put out a meme of SpongeBob SquarePants marking off, cried about Trump, cried about Elon. So some are saying, is this really being done with a lot of dignity?
So this is the reason why I'm putting aside the dignity issues and the questions, even among Republicans that are saying you can make cuts and it doesn't have to be done this way. There's a larger question of how is this going to trickle into the data and how many people are actually leaving the government. And that's the reason why a lot of people are looking at jobless claims on Thursday and trying to decipher some of the counties in Arlington and around the D.C. metro area.
I'll say something quite controversial. I find that the people who are really good at self-evals are often the ones who aren't good at doing the actual work. You know, they're like really good at managing up and not good at like doing the managing.
Deleting my self-evaluation
Just experience.
right
Anyway,
now.
let me turn to this story. I might get in trouble for that one. TD Cowen reporting that Microsoft has cancelled leases for a substantial amount of data center capacity in the United States, amounting to a couple of 100 megawatts. This coming as Alibaba pledges to spend $53 billion on AI infrastructure over the next 3 years.
So this is really important for a lot of investors. Peter Bukvar put this out and said this story out there that Microsoft is canceling AI data center leases gives me more reason to believe that a stock market regime change is upon us, where the AI trade no longer dominates and that DeepSeek was a game changer. A real question about whether you invest in the infrastructure and that's over or not. Microsoft, for its worth, came out and said, listen, we're still investing the $80 billion. We still have our plans. We still believe that there is going to be sufficient demand to meet this supply. That's going to be the real question.
I want to hear from NVIDIA on Wednesday. My question, they came out and said that effort was export compliant. I'm not sure how they know if it is or not. I'm talking about DeepSeek, of course. I'd like someone to follow up on that on Wednesday and actually get some real answers on that front.
Yeah, how much is this, some of the high-powered chips that really fueled this, how much do you see some move to a more efficient way of programming some of these algorithms?
Those numbers drop on Wednesday afternoon. Look out for that. Let's turn to this story. Ukrainian President Volodymyr Zelensky saying the United States dropped its demand for Kyiv to commit to paying $500 billion as part of negotiations on a minerals deal. Zelensky saying U.S. military support must be part of any deal.
They want to see that military support, that military security. We heard from Scott Bessent. They're talking about this administration, that this deal would provide economic security and basically tether Kyiv with Washington when it comes to investment in commodities and raw materials. This deal is still being worked out right now. And it seems like the administration and Volodymyr Zelensky, the president of Ukraine, are using the media to almost negotiate the terms. I think we will get a clearer picture at the end of the week because you have Keir Starmer coming at the end of the week and then, of course, Emmanuel Macron this morning with the president.
Let's build on the conversation. He's 10 years younger. Without a tie, Amos Hochstein, the former senior advisor for energy and investment. Amos, welcome to the programme.
Thank you. It's great to be here.
Good to see you. You seem happy. We can get into that a little bit later. This came from Javier Blas just in the last week. I know you've read the piece. What Ukraine has is scorched earth. What it doesn't have is rare earth. Surprisingly, many people, not least US President Donald Trump, seem convinced the country has a rich mineral endowment. It's a folly. What's your view on all of this?
Well, first, I think Javier has done a lot of research into this. Rare earths, I've never seen any evidence of rare earths in Ukraine. There probably are critical minerals which are different from rare earths in Ukraine, but not at a stage where they've been identified and there's been any exploration drilling, not in any of the commercial quantities that we are aware of. There may be, and there are, I'm sure there's some data there behind some of this that suggests there is. But to get from a greenfield, from a discovery to a production can take many, many years. This is not expanding existing deposits. So I think this is a worthwhile conversation to have with Ukraine about how to develop their mineral resources. We should talk about how to redevelop their gas resources, how to develop their green power resources. Ukraine, I believe, can be a major supplier of power to Europe. Critical minerals, I think, is going to be, regardless of how this turns out, is going to be many years away.
When it comes to all these commodities, wasn't a discussion like this on the table when you were working in government under Biden?
This has been under discussion since I was working in government in the Obama administration. So this has been many, many years. We've always wanted to see Ukraine develop its resources because that will give them economic boost that will allow them to be more independent from Russia and to grow their economy. The corruption was the issue, right? But the resources were there. The issue is we shouldn't be taking the revenue from it. We should want them to have the revenue so that they can invest in the country, so that their Ukrainians across Europe that had to flee can come back and they can rebuild a country, a military, a security apparatus, and a future for their people.
You mentioned corruption. So I am reminded of an opinion piece you wrote in 2020 when you left the supervisory board of Naftogaz. So you've done a lot of work in Ukraine when it comes to this sector. Do you think the corruption has gotten better since then, tackling the corruption?
Not really. I think there's a lot of corruption predates Zelensky. It was a corrupt society before the Maidan revolution. The idea was, let's make it better. I think it did get better, and then some of those efforts stalled. There's been a tradition in government when there's a little bit of stress to go and use that moment to rob the kitty from state-owned enterprises. That's a problem that sort of ebbs and flows. I think it continues with the state control, and during the war, it's hard to criticize during a war when you're having your cities bombed regularly, how you don't do that. So there's a lot of temptation there. But I think it's a systemic issue that the international community should tackle.
For just ignoring some of the more heated rhetoric around the Ukraine-Russia war, because of the lack of accountability of where funding is going, do you think that there is validity in pushing back on just how much the U.S. and even European nations are contributing to the Ukrainians in this Ukraine-Russia war?
Look, you got to separate a couple of things. One is we need to support Ukraine because another country invaded. You can argue whether or not the words that Zelensky used before the invasion were smart or not. Was it good or bad? nothing gives you the right to invade another country because you don't like what the leader said. You just can't do that. So they invaded another country, and we should support it. And they invaded Georgia in 2008. And if we didn't intervene, they would control all of Georgia today and Ukraine. So you got to stop that. Then I think 100%, and we talked about this already in the Biden administration, there's a lot of concern about where's this money going and who's in control of it. And this came up in many conversations with Zelensky, with his top people, about our concerns. So what you should do is tighten the controls on the money and put the oversight in place so that you know where the money is going. But you can't do it while also saying, well, because of that, we're going to allow the Russians to take a whole bunch of territory and win the war. So it's a really tough balance, but, government's hard.
When you left the government, where was the Ukrainian situation in terms of how much territory Russia had taken and the sense of the balance of power at a time where it seemed like Russia was making some inroads?
So Russia was making some inroads, but largely the conflict has been frozen for a long time, where Russia makes a little bit of inroads, then Ukraine makes some inroads somewhere else. On a net basis, Russia was making more inroads than it was losing, but it wasn't massive amounts of territory, so it was largely frozen. But that was in order to get to a negotiation. I agree with the Trump administration that enough is enough. Let's get to a negotiation. I think you have to force both sides to come to the table, and you got to force some tough choices by both sides. Need to make some tough choices. Freezing the war in place and saying, okay, we're done, let's call this a border, is really tough because hundreds of thousands of people have been killed to do what? Just to allow for the parts of the country to go away? And then what? Is there a disarmed Russia on the other side? I don't think so. So they invade again in 2 years, in 4 years. So you have to create a negotiation that has both sides at the table, that allows for some kind of resolution that both sides don't like, but that ends the war.
Some people have made the argument that the current president, President Trump, is attempting to shock the Europeans into action. Can you walk us through your experience with the European allies? How frustrating was that?
I think for us, for the United States, it's always a bit frustrating. I think we like to go a little bit faster, and we want to do things more aggressively when it comes to areas of conflict and negotiations. On the other hand, on the economic policy, we tend to go a little bit slower. On the environmental issues, we were, as a pro-green administration, were frustrated by how far sometimes the Europeans would go without thinking through the consequences of where they were going, and then they would suffer the consequences, which affects us, and they create high watermarks that we then have to deal with our constituencies of why aren't you doing what the Europeans? And it's a bad answer. We say, well, wait 2 to 5 years, you'll see why we're not doing what the Europeans are doing. So I think there's always been frustrations there. We tried to do trade policy with Europe in the Obama administration, the Biden administration, the Trump administration. Now again, very frustrating, very difficult to do it. So it's built into the system, but at the end of the day, these are our allies. And we have to recognize that the argument with them is this is the argument inside the family versus the arguments with others, which is outside the family.
But don't you almost sometimes need to maybe shake them up? You were part of the Obama administration telling Germany not to go ahead with Nord Stream 2, yet they did it.
Yes, and if they didn't do it, large parts of why their declining economy is now would have been avoided. They bought into the argument of your heroin dealer. The first hit is free, and after that you pay a big price. And it's not only that. I went to Germany before the Ukraine war, 5 months before, and said, something's wrong, you're in trouble. And they insisted that they weren't, when the Russians were playing a game of filling their storage in the winter from their own storage instead of from Russia. I said, how is it possible your pipeline's empty, but your storage is filling?
What took the Europeans so long to see the intelligence that the Biden administration was seeing and that Jake Sullivan was openly telling the press from the podium?
We shared all the intelligence. I think sometimes they had the exact same intelligence we had on the invasion. We were saying the invasion's coming on this day, on this week, on this day, at this hour. They refused to see it. No, this is just an exercise. I think sometimes being the neighbor, you kind of can't see us being an ocean away. We see it with clearer eyes. We've missed plenty of intelligence. I don't want to, we had 9/11 that people were training inside the United States and we didn't see it. So I think they were just too close to the Russians and always making the excuses for him. And that was the problem with Merkel and others, they were making the excuses, no, he doesn't mean it. And I think we have to learn a lot of lessons, and Europe has to learn more lessons. But I think they have learned the lesson. They don't want this war to end this way because they're worried that this war, it doesn't end here, and 5 years from now he invades another country.
Wanted to finish on this because we could talk to you all day. I mentioned this a couple of times and I was half joking, but semi-serious, of course, 10 years younger, without the tie. I've said this a few times. There are some really, really smart, intelligent people that work inside our administrations here in the United States. We spoke to one last week, Secretary Besson of the Treasury. I worry more and more as years pass by that those kind of people want to go into US government. I consider you part of that. Dalip Singh, another, Wally Adeyemo, really talented, intelligent individuals. You might disagree with them on their politics, but when it comes to policy, they've thought things through. Do you worry about that too?
I think it's getting harder and harder to come into government. I mean, obviously the hours are terrible, the stress is high, your family time is terrible, and I've seen so much damage to people's families just by making the choice to, especially if you're at the White House or at senior levels in the government. And the problem is, if you're not already wealthy, it's becoming even harder because the income is relatively lower. And I get it, it's higher than the average American salary, but it is lower relative to what the earning potential is for the people that are in those jobs. And the stress on it and the amount that it costs you to manage your life, the government doesn't pay for, and the scrutiny. I mean, I have protesters outside my house yelling that I'm accusing me of genocide, going after my daughter and putting her on Instagram, my 13-year-old. That comes with the job. And it's not like the Secret Service was there to help me or the cops. I mean, they're just standing there watching. So what you get, the blowback that you get, and then to manage your life is really, really difficult. The process for confirmation by the Senate is out of control, and for relatively low-level positions. So to come and be an assistant secretary in some random agency, you are now supposed to hire lawyers and accountants and to do a forensics auditing of your life, of your personal life, of your financial life. I mean, it's too much. And so I worry that outside of it being, you know, I made a lot of money, so I'm going to go into government and play with that for a little bit. And that happens in both parties. I worry that it gets harder and harder to get good people to come in.
I think a lot of people share that worry. Amos, it's good to see you.
Good to see you too.
Hopefully we'll catch up again soon. Amos Hochstein there, the former senior advisor for energy and investment to President Biden. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. At least 3 of ByteDance's major investors have marked up the TikTok owner's valuation to over $400 billion. Sources say that SoftBank's Vision Fund revalued the firm in December, factoring in potential for its AI business. Fidelity Investments and T. Rowe Price also marked up ByteDance. It is a sharp rebound after the threat of a U.S. ban. Elsewhere in China tech, Alibaba plans to invest more than $53 billion on AI infrastructure. That includes data centers over the next 3 years. The investment will be used to support the company's AI ambitions. It also plays into Alibaba's goal of becoming a key partner to companies developing and applying AI. In sports, Liverpool is moving closer to another Premier League title after beating Man City 2-0. Mo Salah scored the team's first goal in the 14th minute and notched an assist on the second. Liverpool now holds an 11-point lead over second-place Arsenal for the top spot on the table after the Gunners lost to West Ham. And that's your brief, John.
That's a happy weekend for Lisa. Danny, thank you. Was that right?
It was.
A better week.
And Mohamed Al-Arian.
Yeah, Mohamed.
So excited.
So pumped for Salah. I know. Up next on the programme, underpriced.
In my mind, the Fed is underpriced at the moment. We have about 2 cuts in the price for the next 18 months or so. In my mind, pricing really skews in favor of them doing more rather than less as this year progresses.
Earl Davis of BMO joins us next from New York City. You're watching Bloomberg TV. Equities bouncing back positive by 0.5% on the S&P 500. In the bond market, bond yields on a 10-year, 444.87. Under surveillance this morning, underpriced.
In my mind, the Fed is underpriced at the moment. We have about 2 cuts in the price for the next 18 months or so. In my mind, pricing really skews in favor of them doing more rather than less as this year progresses. And so the 10-year, the 10-year a little bit too high right now. I'd be shooting sub 4%, closer to 3.5%.
Well, here's the latest. 10-year bond yields declining for 6 consecutive weeks, the longest run since 2019. Earl Davis of BMO expecting more to come, writing, expect 10-year yields to grind lower. Lower 10-year yields will be supportive of risk assets. Earl joins us now for more. Earl, welcome to the programme, sir. Peter Chia of Academy said this only makes sense if the economy is weakening. Does it only make sense if the economy is weakening?
No, it doesn't, and we actually see the economy strengthening, and I'll come back to that in a second. The reason why it doesn't make sense is you just think it's the simple laws of supply and demand. Yes, that demand for there, let's assume it's constant for U.S. Treasuries. The supply is controlled by the Treasury. So even if they need to raise more funds because of deficits, they could control where they issue. And with now the yield curve being not inverted as it was, it's actually cheaper or less expensive for the Fed to issue more T-bills in shorter maturity. We have a sense this is where Secretary Bessent, based on his recent speeches, is leaning towards, is the control, not the control, but maintaining longer term yields at a lower level. And that will help growth.
So, Earl, you're saying that right now the story in the 10-year is a supply story, not anything to do with growth expectations. Is that correct?
That is correct. And actually, and the reason why that's correct is we see growth continuing to accelerate. There's a few reasons why we see that. One is the Fed, basically the only thing they're easing right now is stress test standards. And by easing the stress test standards, that's actually an easing of financial conditions, which helps to stimulate the market. More importantly, the Fed Senior Loan Survey, Officer Survey that came out for the first quarter of 2025 showed an easing of lending standards for the first time in 3 years. That's what will fund and support small and medium-sized businesses and continue to support growth underneath. So although our base case is for no hikes, no eases this year, we are leaning more and more towards the possibility of a hike or a higher possibility of a hike than an ease, given what I just spoken about.
So if you see a hike, how much does that increase the chance of a weakening in the economy? And I'm just putting this out there as people start to think about a stagflationary-like kind of environment. I mean, is that kind of what you foresee later on?
It will weaken the economy, but it'll still be at potential. So the reason why they would hike is twofold. The second one being more important, but let me talk about the economy. The economy is overheating, or the economy is running above potential. So they will hike to get it within the realm of potential. The reason why they target potential and will do it is because inflation in this environment could really pick up. When you have small and medium-sized businesses having increasing access to loans and leases from banks, they are the ones that drive the economy. Combine that with less individuals to hire because of the immigration policy, you could see inflation come through in two ways. And these are the things that we're looking at. We're looking at wage inflation, which is a bit slower in regards to the releases, but as importantly, service inflation. Because where immigrants typically, or undocumented immigrants typically work, is in the services industry. So with less immigration there, we may see that accelerate and continue to keep inflation higher. So the Fed will hike because of that.
Oh, appreciate the perspective. Thank you, sir. Earl Davis there of BMO. Answer the question we've been asking for a while. Does it reflect slower growth or would it support growth? And he's in the latter camp by the sounds of it. Yeah,
that he believes it will support growth. He also believes that this economy is running above potential and that the Fed's going to have to hike rates again. Also, a controversial view at a time where a lot of people seem to be discounting the chance of that rate hike.
That's a very different perspective this morning. Coming up, Yoder of JPMorgan, Geoff Meacham of Citi, Kathy Bostjancic of Nationwide, Krishna Memani of Lafayette College. That's the third hour of Bloomberg Surveillance. Up next.
From an index standpoint, you may not see as much excitement this year.
Markets have been resilient so far and maybe more than resilient in the second half.
When you look under the hood, there's rotation happening and there's dispersion, and that's what's dampening volatility.
Ultimately, it'll be a good environment for stocks, but it's going to be a little bit more difficult.
Right now, it is about being broadly diversified.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. 90 minutes away from the opening bell. Your scores look like this. Equity futures on the S&P 500, firmer by 0.5%, bouncing back from the biggest one-day loss on the S&P of the year so far. On the Nasdaq 100 up by 0.4, on the Russell up by 0.7. This week, full of economic data, including jobless claims on Thursday and the Fed's preferred read of inflation on Friday. Then the big earnings report on Wednesday, Nvidia. But I think we all want another read on the US consumer. Look out for Home Depot coming up tomorrow.
Especially since we do have these fears of inflation, at least among some cohorts that responded to the University of Michigan sentiment survey. How much is that impeding some of the outlook for consumer-facing companies? We saw that from Walmart. It's the 1-2 punch. Consumers need to hold in to keep the economy going, and there has to be the hope that some of the investment in AI is useful and not necessarily going to be overproducing or oversupplying rather than moving to the next phase of the AI adoption.
We've had 6 consecutive weeks of lower 10-year bond yields. This morning, just a little bit higher by 2 basis points. The yield on a 10-year maturity at about 4.45. The data on Friday, difficult to ignore, just not great. Consumer confidence was lower. Inflation expectations were higher. Existing home sales, not impressive. A bad PMI, the worst one we've seen in some 17 months. Put it all together, not a great story to tell.
Not a great story to tell, and it comes at a time when you do see consumers and some companies alluding to the fact that they are concerned about the uncertainty in Washington, D.C. when it comes to tariffs. There's a number of dates on the calendar that we're still waiting to know exactly what level of tariffs will be put in place, whether it's aluminum, the auto sector, Canada, Mexico. The only one so far to stick is an extra 10% on China. On top of that, one thing also interesting, the unemployment rate. That is something that half of these consumers are also concerned about, that's going to go up by the end of the year.
It sounds like a muddle. It sounds uncertain. It sounds scary. And then you look over.
I sound bearish today.
You sound bearish. And then you look over at what's going on in Europe, and they're still struggling to get a coalition together over in Germany. They're going to take 2 months to do it, and there's a question about whether they can increase spending. And this is the reason that even with all of this uncertainty and bearishness coming from us, you have the likes of Morgan Stanley's Mike Wilson coming out and saying it's premature to conclude a rotation away from U.S. stocks is sustainable. And Mislav Mateka of JPMorgan saying something similar. So a real question here about, yes, all those things are true, but the U.S. still may be a brighter spot than some other areas.
We should point out that last week we had record highs on both sides of the Atlantic,
Yes.
both in the United States on the S&P 500 and in Germany on the DAX.
Because ultimately the economy is still working fairly well. And in Europe, it's another story. It's just that there's such little optimism that anything could get done, that a little bit of optimism could ignite that, especially with some of the funds that are coming from the United States.
If you are just joining us, welcome to the program. We do bounce back by 0.5% on the S&P. Coming up this hour, we'll catch up with Yoder of JPMorgan. As equity markets bounce back, we'll speak to Geoff Meacham of Citi. As vaccine stocks rally on reports of a new coronavirus in China, you might want to give that a miss in about 12 minutes' time. Kathy Bostjancic of Nationwide looking ahead to PCE inflation data later this week. No one wants to talk about that story, do they, from Friday?
Well, not really. I mean, really, we really are going to speculate about another pandemic, which we have no visibility on. And yet people are worried about what else can happen, especially with bird flu and egg prices going up. And, how many people send me messages over the weekend? I delete them immediately. But, you got to pay attention.
Jeff's a smart guy. He joins us in 10 minutes' time. Turn the volume up, not down. I said down earlier.
Yeah, you did.
Honestly, I really just don't want to deal with this again. OK. We begin this hour with stocks looking to bounce back from Friday's sell-off. Yoder of JPMorgan writing, the momentum sell-off could be attributed to weaker retail sales and some weaker than anticipated earnings from some retailers, stoking concerns about the health of the US consumer. We think this is overdone. We maintain our year-end price target of 6,400. Abby joins us now for more. Abby, welcome to the programme.
Good morning.
Good to see you. Lots of economic data to get through on Friday. What stood out for you? What was most concerning?
I think the confidence numbers are really what people were gravitating towards in terms of the headline number and the inflation expectations, the longer-term inflation expectations hitting a 30-year high. Again, I think, and you all have been talking about that this morning, really, that if you dig into the details, there's some political leanings that are driving a lot of that. And also, I thought it was interesting, this was the highest level of unsolicited feedback around uncertainty as it relates to the political economy or what's going on environment. So I think that's interesting for that survey in particular. And so that's driving a lot of things that are going on in markets. But I also think, look, we got some data that was a little bit less than, rosy that we've gotten over the past couple of months, but the picture on the consumer is still the same. The narrative's kind of still the same. It's uncertain, but it's still really strong. And I think what we've seen, again, is a momentum unwind and some dollars gravitating towards areas that people were really not loving over the past couple of years.
At the index level, we mentioned the S&P 500 hit a record only last week. Beneath the index, the market internal speaking to that growth slowdown that maybe the bond market's been playing off.
Yeah, I mean, you look at the top of the leaderboard here today, it's staples, healthcare, utilities. It's this really risk-off move. And what you've seen actually, and speaking of that, you've seen just this very stark rotation from cyclicals, out of cyclicals into defensives. But, when I think about that, that's in the U.S. in particular. But then you're also seeing money move to Europe and China, which you would argue is a little bit more cyclical and more risk on. So I'm not really sure what the market's trying to say in terms of where the dollars are flowing.
Do you think that what we're seeing in bond markets is supportive of an ongoing equity rally, or perhaps questioning it just simply because it is on the heels of slower growth fears?
I think it's going to ultimately be a positive for the market. I think the market is very quick to react and change narratives that we're in a Goldilocks scenario and then very quickly say, oh, no, this is recessionary. We saw that last summer very, very quickly. I think once we settle in and we see, we're not in an accelerating growth environment, we're in a moderating growth environment, but at a fine level, right? At trend, let's call it 1.5% to 2%, which is fine. And so once you digest that alongside lower rates, I think that's ultimately a positive for the equity market.
We were talking about the week ahead, and we're concerned about the consumer and some sort of reality check. You said that you think that that's overdone. There's also a question around NVIDIA and how much we see a real shift in the AI story away from some of the picks and hammers and shovels to the applications, the software, et cetera, and how much that could actually pressure the index level just based on how much NVIDIA has been a huge driver. What are you looking for to really understand that?
Well, I mean, look, we've heard from the hyperscalers, they reiterated and even increased their spend. What we want to know is where that like-for-like dollar is going, right? Was it one for one? Is it one for, is it going to the picks and shovels one for one, or is it going elsewhere where it's going to be spread out a little bit more? Are those dollars staying more internally in terms of R&D too? I think that's a good question. For us, I do think, look, the news out of China a couple of weeks ago coinciding with the inauguration was something that we were expecting, the change in the narrative in terms of the AI theme. It just happened a lot quicker than we thought, right? And that's not necessarily a bad thing. These things happen. I think your point around, concentration, that's something that investors have been very concerned about for a long time, right? The past couple of years, let's call it. So I don't know that it would necessarily be a bad thing to see that broadening out in terms of performance. I think what it means is you maybe don't see the market move as swiftly in each direction, right? Like the sell-offs are more extreme, the recoveries are quicker. Maybe that's what the end-all be-all in terms of the index looks like.
You made a good point at the start that when you look at the consumer survey, a lot of it is heavily political. But there potentially could be an impact on tariffs when it comes to companies. How do you look at potentially earnings per share? How much could actually be hit depending on which tariffs we get?
So that's an exercise, right? Because we don't know what exactly is happening, what's written in stone and what's being, just talked about. And we won't know for at least a month, I think, is really the timeline. I think when we think about it, the worst case scenario really would be those 25% tariffs on Canada and Mexico, right? Like those are our real trading partners at the moment. Obviously, from a relationship standpoint, that would be burdensome as well. But if you take everything at face value and you have 25% tariffs across the board on those two trading partners, then you incorporate some kind of tariff, universal tariff in Europe, let's call it 10%, and then incremental in China. I mean, that's a major, major hit to earnings. Let's say we have $30 of earnings that are expected to increase from 2024 to 2025. I mean, you could theoretically see 2/3 of that wiped away from tariffs if you do see that.
If you do see that, then would you have to edit your year-end price target?
Well, yeah, but that's not our base case, right? So inherently, we're maintaining that 6,400 because that is not what we foresee coming to fruition. It's just a risk that's out there. And I think when you're thinking about not only consumers, but corporates, we've heard this over the past, during earnings season, which has been phenomenal, by the way, like 16% year-over-year growth for 4Q, highest level of growth since 2021. You're just not getting the enthusiasm around the outlook because it's uncertain, right? And what happened after the election was these animal spirits and this risk on move, but then it's being outweighed now, I think, by the uncertainty as it relates to tariffs. But to the point, we're still only 2% from the highs.
Your regional preference is the United States over the rest of the world. Europe has outperformed so far. Double-digit returns in places like Germany, in France as well. What's behind that move for you? Do you think it's sustainable?
Well, so I think the way that we're viewing it, you've seen a move in the multiple from 13 to 15 times. Historically, on average, it's around 14 times. So we're above average in terms of what we're seeing in terms of the multiple. You haven't seen it move from a fundamental standpoint on the earnings side. You've seen earnings come in a little bit better than expected there. Nothing, needle moving. And it's really a matter of like China's a little bit better than expected. Europe's okay. US is really what's holding it up. So to be able to, see a sustained outperformance, we can't get any more multiple expansion in our view. We're going to have to see it come from earnings. So until then, we're still on the sidelines there.
Just to wrap it up, Lisa wants to know if you're worried about bats and whether that changes the story.
About bats?
Bats, coronavirus.
Yeah, coronavirus.
Oh, well, actually, when you were saying let's not talk about the coronavirus, I was like, aren't we still on bird flu? Like I am on egg prices.
Exactly, right? But isn't that what everyone sends you messages about, all of your friends? Is this going to be real? How many eggs did you hear about the person who was killed over the weekend, who is a farmer, who is a dairy worker? My friend's just crazy.
Your
I'm just saying.
Conversations get dark. I didn't get those messages over the weekend at all.
Okay, well, do not disturb over the weekend for me.
Abby, appreciate your time. It's good to see you. Thank you. We'll leave that there. Abby Yoder of JPMorgan and the thoughts of Bramo over the weekend. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu said the new Syrian regime must demilitarize southern Syria. Netanyahu said that he won't allow the new administration to push forces into territory south of Damascus. Israel advanced eastward into Syria, creating a buffer zone after the former government was overthrown by rebels. Apple has said it will add 20,000 new workers and produce AI servers in the U.S. The company plans to spend $500 billion domestically over the next 4 years. It will include work on new server manufacturing facilities in Houston and a supplier academy in Michigan. President Trump responding to the news, posting on Truth Social, "Thank you, Tim Cook and Apple." New York City's congestion pricing program raised $48.6 million in its first month. The program has reduced traffic by 10%, with 2.6 million fewer vehicles south of 60th Street. The MTA plans to sell bonds next year to finance $15 billion of infrastructure upgrades repaid with congestion pricing revenue, and has seen increased paid rideship on subways and commuter rail lines. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes. You two done arguing over that?
Well, Governor Hochul went to the White House and tried to make this case to President Trump that congestion pricing works. They need this money, to Lisa's point. I think Trump said he's not budging on this one.
I just am writing my self-evaluation. Will not be so bearish. Will not focus on bird flu.
Doing your South eval. We back to that again. I got a message from management. You and I didn't do one.
You did. No, I didn't. I did not do one. Okay. But I will say we don't really need to do one. You can watch us every day at 6 to 9. So if Elon Musk was to send us those bullet points, it would just say tune in.
That's what you'd say to management.
Tune in.
Okay. Good. You had your eval. Up next on the programme, the Morning Calls plus Geoff Meacham of Citi as vaccine stocks rise on reports of a new coronavirus out of China. That conversation next. This is Bloomberg. The opening bell is 1 hour and 14 minutes away. Equities still positive by 0.5% on the S&P, and the bond market bond yields just about unchanged. The 10-year 443. 51. Let's get you some morning calls. First up, Jefferies upgrading Nike to buy. The analyst saying the new CEO has the right playbook. That stock is up by 2.3%. Your second call from Bank of America downgrading Rivian to underperform, saying its Volkswagen partnership is complicating earnings forecasts. That stock is down by about 3%. And finally, Morgan Stanley upgrading Alibaba to overweight, expecting cloud revenue to double in just 3 years. That stock a bit softer. It's rallied recently, but we're down this morning by a bit more than 3%. Let's turn to pharmaceuticals. Some vaccine makers rallying after researchers in Wuhan, China said they discovered a new coronavirus in bats, similar to COVID-19. The virus has yet to be detected in humans. Joining us now, Geoff Meacham of Citi. Geoff, welcome to the programme, sir. One of those occasions, and I said to you in a commercial break, where I'm really happy to see you, but really don't want to talk about this subject, but we have to. The news out just before the weekend, Geoff. From your perspective, how serious is this?
Thanks for having me. Yeah, and I'm with you. No one really wants to talk about, COVID going back to the 2020 sort of era. And I don't think we will. When you look at the seriousness of this, there is billions of folks that have been vaccinated, have been boosted. I think that protects against if there is sort of bat to human transition. There's a lot of folks that have, sort of immune protected. I don't think we're going to have a round of boosters, for example. And just in case, there is Pfizer's Paxlovid, I think, which could, address obviously some of those more severe symptoms. So don't fret yet, is my is the comment.
Love that. I'm very excited to hear more of this sort of soothing rhetoric. I am curious just how much vaccine makers have the capacity to ramp up production and, frankly, innovate new vaccines with some of the new technologies that they're using. Should there be a new virus that does come out? In other words, are they sort of more capable than they were 5 years ago to really stave off a pandemic?
Yeah, for sure. I mean, if you look at, Pfizer and Moderna, the manufacturing investments they've made over COVID, obviously they've had to redeploy some of that as vaccine demands have gone down. But, whether that's a new variant or whether it's a meaningfully different look of COVID, the capacity, the R&D, the investments are there. And I would say in general, though, maybe a next-gen Paxlovid would be helpful, just having another oral drug available, which could address signs and symptoms. But that drug itself is, I think, pretty good, for getting rid of, some of the patients that are most at risk, immunocompromised, et cetera.
Geoff, on Friday, there were a lot of reasons for markets to sell off, and there was a risk-off mood. But some people said it was because they got a number of emails about bats in Wuhan, and that's always sort of traumatizing for people. How do you gauge whether something is a real threat or not, whether it actually is going to boost sales of some of these vaccine makers, but more importantly, cause real havoc?
We've looked back at what companies said, on fourth quarter and what they assume for 2025. In general, I think we've been in a market of stability for some of the vaccine makers for 2023, 2024. There haven't been a lot of new changes to demand, and obviously the supply can be there if a new variant, for example, comes out and has a massive sort of infection wave. But in general, though, I don't know if we're going to see another boon to vaccine makers. What I guess I would be worried about is if there is a new variant that was extremely virulent, much more so than this Omicron subvariant. And we just haven't seen that yet.
Lisa, I don't think people will comply in the same way they did 4 or 5 years ago. I don't think they'll be able to mandate it in the same way they did 4 or 5 years ago. I hope we don't even have to talk about this in the next couple of months, but you can really feel the mood based from the conversations you've had over the weekend and the conversations I had as well.
Yeah, I don't think I could mandate it with my family, let alone have some sort of broader mandate, because it was deeply traumatic for a whole generation of kids. And I point to kids in particular because the socialization was so important at that point. So at a certain point, you have to think the tools have to come from the medical community. And it raises the question of Steve Pagliuca when he was talking about the developments using machine learning to really innovate and speed up the process for vaccines.
Geoff, I know you don't cover Moderna, but Moderna's really struggled over the last couple of years, over the last 12 months particularly. Geoff, I think if you're a company and you're waiting for the next pandemic, some people might say you don't have much of a business, if that's the business. What's Pfizer been doing, a company that you do cover? What have they been doing? Because they're not waiting for the next pandemic. What kind of offering do they have right now away from this conversation?
Right. So, from a Moderna perspective, I mean, they've obviously moved on from, a primary focus of vaccines into things like oncology, infectious or rare diseases, which is I think a good application of the mRNA technology. I wouldn't say Pfizer has really taken the mRNA technology to the next level. Their partner, BioNTech, is mostly oncology, but Pfizer has done a number of things in cancer. The Seagen acquisition, I think, is super helpful when it comes to adding to their portfolio and their pipeline. So they're investing in other segments, but I don't think they're by no means doubling down right on vaccines.
Geoff, how do you take into account some of what we're hearing from the administration, given that there has been a crackdown on spending with Medicare and Medicaid, but also just with RFK Jr. in the office talking about vaccines and raising some questions? Has that affected any of the outlooks or the investment profiles of any of the pharmaceutical companies that you cover?
For sure. A lot of investors are looking to, Pfizer, to some degree, Merck, some of the earlier stager companies like a Moderna, with less, on a dollar basis, less robust pipelines. But I would say in general, though, it's unlikely that you're going to see a lot of big companies maybe double down on their vaccine, kind of portfolios or their pipelines in terms of new vaccines that are needed. Most investors, I think, are worried enough about the risk that they're looking at, more easily understood markets like GLP-1s or oncology or, say other infectious diseases. I just don't get the impression that, we're hearing from leadership from a lot of biopharmas that vaccines are the way to go. And so there is a bit of a reactionary approach to some of the uncertainty from RFKJ, for example.
Well, when it comes to uncertainty, we also see the CDC's quote unquote disease detectors. These are the individuals that go out, say there's an Ebola outbreak in Africa and have to go find out more about it. How much of a data gap could there potentially be for some of these companies if they're not going to be getting that data from the U.S. government?
Yeah, it's a good point. I mean, I would say the good thing is that you have a technology like mRNA, which can react very quickly to a lot of the viruses that we're talking about. Could be bird flu. Historically, it's been Zika, for example, rotavirus, norovirus. So the technology is there to react quickly to a new and emergent virus. And so I feel pretty comfortable in the safety profile of that technology. And so that's why I sort of can rest somewhat easy knowing that the speed of addressing a potential emergent variant could be pretty fast.
You've made us all feel a lot better, Geoff. Appreciate it. Geoff Meacham there of Citi. Geoff, thank you. That news dropped. What was it, Thursday night, Friday morning?
Yeah.
Started to move stocks, the vaccine makers, the likes of Moderna. I just sat there shaking my head. My phone has started getting the messages, literally repeat.
Yeah.
On repeat. I'm not doing this. We're not doing this again.
Not going to comply, even if it does. I love it. You were saying, turn down the volume. It's going to be awful. It's going to be scary. And he comes down and he says, basically, is it really that big of a deal? We've got vaccines. We can handle it.
Even Jeff's reluctant to talk about it. Up next on the programme, we'll talk about the economic data. Kathy Bostjancic of Nationwide. Krishna Memani of Lafayette College. That data on Friday, just how reliable is it? And will it be confirmed by economic data still to come? Still to come this week, we've got jobless claims on Thursday and core PCE on Friday. Equity futures on the S&P 500 with 60 minutes until the opening bell. Firmer here by 0.5%, bouncing back from Friday's losses. In the bond market, yields just about unchanged. The 10-year 4.43. From New York, this is Bloomberg. Equity futures positive here by 0.5%. The opening bell about 60 minutes away. Let's get you some morning movers. We can get those with Yohara Hackers. Morning, Yohara.
Hi, John. We start with Tesla. The stock has been feeling pressure lately, and this is Domino's, not Tesla, but we'll get to Tesla soon. Tesla's shares have been feeling pressure lately, and it's no different today. And of course, some of that has to do with investors feeling like, there it is, Tesla now up. And that is on this news that we just received, which is that Tesla's premium cars will be getting a refresh. Apparently, there was an interview with a company executive, Lars Morave, who said that refresh will be coming later this year. But it's all over the map now, John. Next up, we have Coinbase shares. Those are recovering here. It's been whiplash for the shares ever since that announcement that U.S. regulators are planning to dismiss a legal case against them, because just hours later, we got news that there was a massive hack where about $1.5 billion worth of tokens were stolen at another exchange called Bybit. So Coinbase shares fell on that news, but it appears the happy mood is back in the crypto sector. And next up, we have Freshpet shares. Those are getting a boost after analysts over at Jefferies upgraded the stock to a buy. They're up about 5% now. And not only are they seeing positive revenue trends because people keep spending on their pets, they're saying the stock is worth 50% from where it's trading now. John?
Yahara, thank you. Appreciate it. You know the game that TK used to play with me, foreign exchange roulette? Used to join the program from London, Bloomberg Surveillance here in New York. I'd get on there, A block, top of the program. He'd bring me in to talk about markets. Argentina, go. That was it. It was like foreign exchange roulette. Argentina, go. Switzerland, go. And I had no idea what was happening. And these graphics would just come up on the screen.
Exactly.
And I'd have to respond to like whatever was happening in Argentina.
He loves the Thai baht.
I
remember a week of that.
Hungary, the foreign. Yeah.
Oh, yeah. Hungary was a big one. How about, why is the Swissy here?
Loved FX roulette. Me, not so much. Investors looking ahead to key data ahead this week with the core PCE inflation print due out on Friday. Michael McKee, our economics and policy correspondent, joins us now for more. Mike, lots of economic data. What tops the pile for you?
Well, it's going to be a Friday deal, Don, because we're going to be looking at PCE, the personal consumption expenditures index, and also personal consumption. And we'll see whether consumers continue to spend. The big news is that we're expecting a mild PCE inflation number on Friday, just 2.6% for the core on a year-over-year basis, suggesting that the Fed is still making progress. We get consumer confidence tomorrow after the Michigan numbers upset the markets on Friday. That will be interesting. Durable goods, our companies still investing, and jobless claims, we'll be watching for any sign that federal government workers have been laid off. Lots of Fed speak, as you can see that calendar go by. Not really going to matter a whole lot because the deadlines for Donald Trump's tariff announcements aren't until next week and the week after. So the Fed is basically still in the same position it has been. We just don't know what the president is going to do, so we just can't make any decisions on what we're going to do. And John, I'll finish up by noting that Argentina has an economic activity index coming out on tomorrow. So that's going to be the news of the day there in Argentina.
I'm pleased you're still on top of things, Mike, because I'm not in the same way. Michael McKee there, looking at that economic data a little bit later through the week. We'll be looking for jobless claims on Thursday. This coming from Starbucks this morning, cutting 1,100 corporate jobs worldwide. Seen a few of these headlines from various companies, haven't we, over the past few weeks?
Yeah, and a real question about whether this is just simply culling the fat kind of cuts or whether it's something more significant. Starbucks said that they're going to notify employees who are losing their jobs by tomorrow, by February 25th, and they're limiting several hundred open and unfilled roles. This is a real question, though. Is this the time for people to make efficiency reductions, or is this in response to something more?
I got to shake my head, though, when I see this headline drop. North America VPs at Starbucks need to be in the office at least 3 days a week. 2025, and they need to be in the office at least 3 days a week. Meanwhile, you're cutting a number of corporate jobs worldwide. It just feels like this is stale and outdated.
This is part of the Brian Nichols shake-up. Got to remember that as well at the same time. Is it a cyclical signal? I think it's Brian putting his stamp on a company over the past few weeks.
Speaking of Brian Nichols, is he remote? Isn't he working in a different place? I'm just saying. I mean, I
think he has access to a Gulf Stream and goes back and forth.
I'm just saying,
I think Brian has different access to travel than maybe others do. at Starbucks?
Look, I think that you're right. Starbucks is specific, but we are seeing a number of job cuts being announced, particularly of big tech. And you do wonder how much this is going to be an increasing efficiency play.
Stock is down by about 0.2%. Jobless claims just around a corner. Kathy Bostjancic of Nationwide Mutual Insurance expecting consumer confidence to reflect caution and optimism, and income and spending to advance at a slower pace. Kathy joins us now for more. Kathy, before we look forward, I want to look back just a little bit. Mitch Consumer Sentiment Survey gets lots of attention. Does it deserve it?
Good morning, John. Well, it does in some sense. In fact, what I find most useful is the inflation expectations component, and particularly the 5 to 10 year portion. And then we know the Fed focuses on that, right? That's a longer inflation expectations component. The sentiment index, if you break that down upon amid political leanings, it's really sways, right? When Republicans are in power, their optimism is very high and Democrats are in the dumpster, and vice versa. So it is very sentiment based and maybe not based on the economic reality. Plus, as you know, right, consumers continued to spend even when sentiment was really low. So we need to look at the fundamentals, and the labor market is key.
It's getting harder and harder to understand what the fundamentals are as we get a lot of noise. And we're talking about consumer sentiment, how politically it's being driven. We talk about the jobs market and how politically driven that might be. Earlier this morning, we got news from Apple, 20,000 new U.S. jobs with a nod to Donald Trump. This morning, Starbucks job cuts. Which is it? Is it jobs being created in the U.S. or is it jobs being pared back? Which headlines should we pay more attention to?
Well, good question. One thing, there's always jobs created and lost, right? There's tremendous churn in the U.S. labor market. And what we see and usually focus on is the net payroll number, right? Or net household employment number. But this churn continues to go on and on. From all indications right now, the labor market is still very strong. There certainly can be headline announcements here or there. Jobless claims still remain incredibly low, continuing claims. I don't get a sense that we're seeing a big change. Now, of course, we have to be nimble, right? And because the economy can operate on the margin and changes can occur, but we're not really quite seeing that at this moment.
John, you were talking about Brian Niccol. I was a little distracted because he's got a corporate jet. Yes, he does. But his offer letter included a small remote office at his home in Newport Beach, and he was expected to be in the office 3 days a week, which is exactly what they're saying to other people, that they have to be back in the office.
Can the office be Newport Beach?
I don't know if they can join his small private, small home
like
office.
The remote office, the official office.
I don't know if that is the official office, but I just know that was sort of the distinguishing feature. Kathy, we're talking about the idea of coming back to the office, and we're seeing that with certainly the federal workforce being demanded to come back to the office. We're wondering whether this highlights how much companies are getting the upper hand with workers in a new way than, say, 3 years ago, when they couldn't have mandated return to work in the same kind of way. Do you view it as that?
Well, I think it comes down to probably, different companies making their own decisions for the workforce. I would say that there is perhaps more leverage for companies and maybe more of a need to bring people together. But I think it is very, it's idiosyncratic. And I think, businesses have to decide what model works, best for them. And I think as you talk about Starbucks, that's a very different, company. And I wouldn't say it's cyclical at all. As you mentioned, it has its own struggles that are really separate from the overall economy, which up until this point has been booming, actually.
Kathy, we've been talking a lot about the effects of the federal workforce and what DOGE is doing. On average, last year, we saw the U.S. government add about 35,000 people, once a month, and we got the non-farm payroll numbers. Do you expect a hit on the federal workforce to impact the jobs report?
So we're watching it. We're acutely, aware of the announcements and the work that's being done. We're trying to keep a spreadsheet and a tally of that. Not easy. But also remember, in that breakdown of the government, half is state and local, and actually probably even more is just state and local than federal. So that's one thing to keep in mind. And with these announcements of federal, it's not clear how many people were going to retire anyhow. There's a normal churn in the government sector as well. So it may be all told that the negative hit to employment is slower to unfold and maybe ultimately less than the 10% at least that they initially were talking about. So my sense is, and people are on deferred contracts. So my sense is we're going to see the hit at some point, but it will be kind of more of a drip than a big drop.
Kathy, appreciate it. Going into the economic data later this week. Kathy Bostjancic there of Nationwide on the data we've seen so far as well. Bit of a scare on Friday. I think we need to take a step back, get some perspective. Equity still very close to all-time highs. Unemployment still around 4%. Jobless claims in the low 200,000s. But I respect why people are jittery. We've got a new source of risk, tariffs, policy uncertainty. That's something we didn't have over the past year. Cuts to Washington in the long term might be a good thing. In the short term, might provide some disruption to the economic data. Got to think about this, though. What's worse than an economic slowdown? It's an economic slowdown the Fed cannot respond to or is unwilling to respond to. And Neil Dutter's making that point at the moment over at Renmac. The Fed doesn't have your back right now. That's a quote from Neil over the past week or so. That's a change.
It's a change at a time where people are worried about inflation still. And this raises a question of, is inflation as a concern overblown, which is something that Neil Dutta has made the point of. You can't have an inflationary shock if you have the housing market flat on its back. Or is this a Fed that has its hands tied because we are in a more stagflationary-like environment? And those are two different scenarios, and that's one of the key debates right now.
Neil Dutta joining us tomorrow, so look out for that on Bloomberg Surveillance. Here's the take from Krishna Memani of Lafayette College. He goes on to say, what we have is a potentially softening economy that is being hit over the head with 2x4s of policy uncertainty instead of being nurtured. It's not good. Krishna joins us now for more. So, Krishna, the question I've got to ask you, sir, is why are we still very close to all-time highs on the S&P 500?
So the underlying economy continues to do well, as you just said. Economic growth is decent, employment is good, income growth is substantial, and the consumers continue to spend. So the challenge is really not right now. The challenge is 6 months out. So if you are a corporate executive and you're trying to make an investment decision as opposed to a consumption decision for your groceries or whatever else that you do, and your investment period is 4 or 5 years, I mean, do you just jump in and do all the things that you were planning on doing, or then let's take a pause and see how all of this works out? And I think that's really the risk. The risk isn't the current state of the economy. The risk is we may be potentially slowing down. The Fed can't do anything, and on the policy front, we are getting hit every day, twice a day.
If the risk is people pause, Krishna, and maybe that's reflected in the labour market as well, reinforced by this low churn dynamic which has gripped the US labour market too, what is most at risk in the equity market?
Well, so in the equity market, what is most at risk is really things that are extraordinarily high valuations, rather than things where the near-term impact of a potential slight slowdown would be substantial. So it's really the tech sector that is very vulnerable, not because they're not making money. It's just that their valuations are too high.
You wrote in your notes, Krishna, that not having a view is still the best strategy. How do you not have a view as an investor that has to actively put money to work?
Well, so, as an investor, you have a long-term target, and then you move around that target. So if you have a view, then you can adjust that target on a tactical basis. So not having a view for somebody like us who are investing for 20 years, 30 years, doesn't mean that we get out of the equity market. It's just that we don't overweight equity markets or particular sectors of the equity market.
Do you have a view then on the equity bond mix? Because one of the fundamental questions right now is whether some of the structural changes that are occurring right now in Washington, D.C. are going to change the trajectory for U.S. debt markets going forward, whether it has to do with reducing the deficit or whether it has to do with things like the Mar-a-Lago Accord, which had all sorts of excitement over the weekend. How do you view that in terms of longer-term balance?
So I think the reducing the deficit is a very noble goal. However, when we are talking about large tax cuts at the same time, from a realistic standpoint, that doesn't really reduce deficit in any significant or meaningful way. So I think if the structure of the market is going to change, it is not going to change because we have somehow found a magical way of reducing our deficit from very high levels that we have today. And as far as Mar-a-Lago Accord is concerned, I kind of shake my head, as somebody said a little earlier. It's like, this is third world thinking as opposed to a first world thinking. If the U.S. goes down that path, I don't know what to say. It'll be hell to pay at some point, it seems to me.
Krishna, when it comes to this policy uncertainty, you say it needs to be nurtured right now. What would you want to see out of the administration from a market perspective?
So I think the administration has some really nice goals that, rebalancing trade, creating jobs in the U.S. All those would be very good objectives, and I think are going to help the U.S. economy in the long run. It's just the way they are coming and the way the volatility is. We do say that we do something one day, take it back. We say something that we are going to do, then we postpone it. I think that that's really the issue. That is, we don't know exactly how things are going to shake up, what the timing of all of those things is. It's really more about that than anything else.
Hey, Krishna, always appreciate and respect your views, sir. I want to finish up with this. What would you do right now in markets? What are you doing?
Well, so, we are keeping ourselves very close to our long-term targets. If I have any spare money that I would like to invest, I would invest in bonds far more than equities. That's not a message that the market is taking to heart right now, but the risk is more on the downside with respect to the economic growth picture, employment, than it is for it to re-accelerate.
Hey, Krishna. Thank you, sir. Krishna Memani there of Lafayette College. Mentioned Nela Richardson of Renmark, who will be with us tomorrow, published this just moments ago. Let me share it with you. Much of what we see in the financial press, tariffs, uncertainty, is a red herring. Goes on to say, an ex-post rationalisation for an economic slowdown that was already in motion. I would anticipate a decline in longer-term interest rates and a sell-off in equity prices as risk appetite wanes. For the economy, expect conditions to deteriorate in the jobs market.
This is the reason why some people don't think that a decline in the 10-year is a positive thing for equities. Just take what we just heard from you, that you read about from Neil Dutta, versus Earl Davis, who said the reason why 10-year Treasury yields were going down was because the Treasury Department wasn't issuing longer-term debt. It just highlights how you can give two people the same metrics in the market, the same information. They can come to diametrically opposed rationales for what's going on, and it really highlights the uncertainty of to this moment.
Do you know who might have some sympathy with one dimension of what Neil Dutta had to say? A surprising source might be Kevin Hassett, National Economic Council Director, who a few Fridays ago after the payrolls report suggested that maybe this labour market wasn't as strong as some people thought it was coming into 2025.
This will get tested in 6 months when they can't necessarily attribute that to the previous administration. But you're right. How long can that kind of carry through before those pro-growth policies start to give tailwinds to a different narrative?
Looking forward to catching up with Neil tomorrow morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Trump administration sent emails to more than 2 million federal workers, ordering them to report on what they did last week or be forced to resign. The deadline to reply is just before midnight in Washington. Elon Musk said the directive came directly from President Trump. However, several agencies, including the FBI, NASA, and the Pentagon, have asked employees to hit the pause on acting on the directive. Ukrainian President Volodymyr Zelensky says that he's willing to step down if it means peace and NATO membership for his country. Zelensky says it's clear he wouldn't be in power for decades and would happily make that trade if the offer was made. Elsewhere, Pope Francis remains in critical condition as he continues to battle severe pneumonia. The Vatican says that the 88-year-old pontiff is still receiving high-flow oxygen to help with his breathing. Some blood tests show an initial mild renal failure, which is currently under control. The Vatican says the Pope continues to be alert and well-oriented. And that's your brief, John.
Danny, thank you. He'll be in our prayers, of course. Up next on the programme, we'll set you up for the week ahead. You're watching Bloomberg TV. Equities positive here by 0.5% on the S&P 500. Bond yields higher by just a basis point on the 10-year, 444.68. The opening bell about 38 minutes away. The week ahead looks like this. Tomorrow, earnings from Home Depot. Wednesday, the big one. Nvidia. On Thursday, another round of jobless claims, GDP and durable goods. And on Friday, core PCE, the Fed's preferred inflation read. Look out for that. We're also watching a midnight deadline for federal workers. Elon Musk's Doge sending a mass email over the weekend demanding they defend their work. Tyler Kendall joined us now from DC for more. Tyler, what's next?
Well, John, there's still conflicting guidance out there after many agencies told employees not to respond. What that signals to us is that these agencies didn't get a heads up before this memo went out. Now, it's still unclear what sort of legal basis Elon Musk, in his capacity as a special advisor to President Trump, would have to terminate federal workers. But President Trump did make clear that he would like to see Doge get more aggressive. When we are talking about what's next, these legal questions, we are expecting the largest union representing federal workers to contest any firings that could come if people do not respond to this email. And remember, this really could be widespread. Only about 20% of the federal workforce is in the nation's capital and the surrounding areas. And often we talk about President Trump trying to shake up Washington institutions, but of course, this could go much broader than that and across the country. John, you've been talking about consumer sentiment all morning. When we talk about the University of Michigan's gauge that was out on Friday, it showed more than 50% of respondents said that their long-term unemployment expectations had risen. That is one of the highest numbers that we've seen since April of 2020, when we were in the height of the pandemic.
So the president has a busy day today when it comes to the international space. Emmanuel Macron is already in the White House with him. They have a call at 8 o'clock. Well, they're on it right now. When it comes to other G7 leaders, what's on tap between these two leaders today?
Right, exactly, Annmarie. They'll have a bilateral meeting followed by a lunch and then a 2 p.m. Eastern press conference. We'll be waiting to see what sort of headlines, particularly when it comes to security guarantees from Europe, come out of that. But also, I'm closely watching to see if we get any indication about how tariff negotiations are going. Of course, we know that pending aluminum, steel, auto tariffs could really hit the European Union. But Annmarie, I would just point out some interesting timing. Late Friday night, President Trump opening the door to potentially implementing tariffs as a way to counteract digital services taxes. I bring that up because France was one of the first countries to implement a DST back in 2019. It's something that President Trump tried to get rid of during his first term in office. And of course, these hit some of the biggest U.S. tech companies like Meta and Alphabet. And considering the Apple news earlier this morning, it would appear that tech is at least somewhat on President Trump's mind.
Hey, Tyler, appreciate it. Thank you. Tyler Kendall down in Washington, D.C. Haven't talked about it much this morning at all, but also pushing Mexico to put their own tariffs on China to prevent the goods coming through the back door into the United States.
This is the real story, though. And actually, this is the one that you got to pay attention to. There has been a longstanding gripe that has crossed administrations about Mexico being the back door for China products into the United States. And that is a real question. If you want to isolate the two economies, how do you do it without some of the allies participating?
It's a warning shot to anyone that wants to do nearshoring or friendshoring. You have to make sure that you are still isolating China when you're doing that, if you want your products welcomed in the United States.
It's a good start to the week. Equities bouncing back by 0.5%. Long week still to come. Coming up tomorrow, Sharon Bell of Goldman Sachs, Mike Wilson of Morgan Stanley publishing a little bit earlier. The debate turns to growth. The debate is turning to growth in a big way. Bond yields down for 6 consecutive weeks coming into this week. The longest weekly run since 2019. Tom Kennedy of JPMorgan will respond to that, and Neil Dutta of Renmark on why he is not constructive on this economy and hasn't been for a number of months. That conversation coming up tomorrow morning. Live from New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance. This is Bloomberg TV.